back to where we were in January with a different set of risk and a different set of facts, which look worse.
When you look at this year, markets have gone through the entire range of emotions.
Yes, the market is very resilient, but yes, it's very well aware of what's going on.
There's clearly signs of softening, but everything's been very low grade.
The macro picture for now is still not too weak.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome to Bloomberg Surveillance, where we're playing the two-week waiting game. President Trump deciding whether to strike Iran's nuclear sites within the next 2 weeks. Congress careening toward a self-imposed July 4th deadline in about 2 weeks to pass President Trump's one big beautiful bill. And countries racing to make trade deals ahead of the reciprocal tariff deadline just a little more than 2 weeks away. This seems to be the theme right now. And what you got in markets is, why would anyone take risk heading into a weekend where potentially everything could be upended by geopolitics? You're seeing a little bit of softness in futures pretty much across the board, down about 0.2% on the S&P. Meanwhile, really quiet, not a lot going on, because again, why would anyone make big, bold moves ahead of what we are going to see? Crude prices higher yet again as people try to game out what this means. And I do just look at the full month performance, and we are up more than 20% on WTI, on Brent crude. That is the most for a month going back to November 2020, which gives you a sense of just how unusual this is and just how much risk has been priced into that market as we do look at what's going on with Iran and Israel. Coming up this hour, we've got Brian Levitt of Invesco with stocks on hold amid geopolitical tension. Andrew Bishop of Signum, as President Trump says he'll decide whether to strike Iran in, you got it, 2 weeks. And Stephanie Roth of Wolfe Research's Fed Chair Jay Powell says tariff impacts are coming, and until then, they did a really good job in saying absolutely nothing. We begin this hour with stocks on hold. President Trump setting on a 2-week deadline to decide whether to strike Iran. Brian Levitt of Invesco writing, geopolitical conflicts and wars often trigger immediate volatility in financial markets. Unsettling events are unlikely to derail broader market cycles. Brian joins us now. And Brian, good morning. Great to see you.
Good morning.
Nice to be here. Thank you for being here. They all abandoned me. John is going to be back on Monday, and Annmarie will be back next week. There is a question right now. I know that people say geopolitics tends to be something that is short-lived. At this moment, though, why would anyone take risk at a time of this 2-week uncertainty perpetually?
I think these markets are incredibly hard to time. So each time over this year that we've thought it's the worst possible moment to take risks, something has come along that has alleviated some of the policy or political uncertainty that has persisted. I mean, we probably could have asked the same question a couple of days after Liberation Day as well. And if you also remember a couple of weeks later when the concern was that we were going to fire Jerome Powell, we probably could have asked the same question. So the reality is, as an investor, you look at a macro environment where growth continues to be okay, inflation still stable. We'll see for how long. But the good news is inflation expectations stable. Federal Reserve that seems to be leaning a little bit dovish. And that's why you would want to be on the side of risk assets.
Let's build on that.
Yeah.
We've seen central banks around the world lean to the more dovish side recently, which has been something of a theme. We saw that overnight with respect to the EC, with the Bank of England. They didn't cut, but the vote was split, with a number actually saying they wanted to cut. You saw this with the Swiss National Bank cutting rates to zero. The expectation is they will go negative. How much is this a real tailwind that people maybe haven't fully priced in, given that the Fed may, depending on the data, follow suit?
It's a tailwind for the market. I'm not sure it's necessarily a huge tailwind for the U.S. economy, the same way it wasn't a huge headwind when we were raising rates in 22 and 23, primarily because most Americans have fixed rate mortgages. Most businesses had locked in lower yields. But what it does do is it helps the financial system. It helps smaller businesses. It helps anyone that has near-term refinancing needs. So it certainly matters. I'm not saying Federal Reserve is going to step step in and we're going to have lights out economic activity. But it certainly matters to smaller businesses and can certainly matter to financial conditions.
Which is the reason why perhaps we've seen the outperformance in the Russell 2000. It's up 0.8% so far on the week. That is the best performing index that we've got of the major indices. How much do you think that is something that can be sustained going forward if we get some of the backdrop that we're seeing over the past couple of weeks?
Small caps have been beaten up, so the valuations look very attractive to the larger capitalization. What you need from small caps is A, lower interest rates, B, a better economic environment. So you need a reacceleration. Right now, you have one of those that you don't really have either, but the expectation is that you may get lower interest rates. What you have right now globally in terms of leading indicators of activity are most things are pointing towards lower growth. And the easiest way to summarize that is nobody really wins in a trade war. So you will need to see when you have leading indicators pointing lower, we're so used to policymakers responding. Now, outside the United States, they are able to because they're dealing with perhaps more deflationary impulses in the more export-driven economies. In the United States, we may not have enough stuff, so you're dealing with a little bit of concern of inflation, but ultimately we think the Fed steps forward.
How much do higher oil prices torpedo that entire narrative? And this comes at a time where potentially the U.S. could get more intricately involved in what's going on in Iran.
I would look at higher oil prices as being more of a tax on the consumer and a headwind to growth rather than a concern for the Federal Reserve that there's going to be a reacceleration in inflation. Again, the inflation expectations remain very contained. That is important. And there's a reason why the Federal Reserve sets policy by stripping out food and energy. I mean, I've had people say to me, they don't drive, they don't eat food. No, they do, but they don't want to set policy based on price shocks. They want to set policy based on what they think is going to be sustained moves in prices. And so what you have right now is the Federal Reserve looking at higher energy prices and perhaps higher goods prices because of tariffs. But what they're essentially telling the market is we're going to view both of those things as price shocks, not as the beginning of a sustained inflation environment.
Which is the reason why maybe some people were surprised that we saw a dovish tilt to central banks. You don't sound surprised, given the fact that, yes, on the headline level in Europe, for example, you might see even more of a hit to CPI on the upside from oil prices and some of the geopolitics. At the same time, they're treating this as more of a risk to growth. Is that what you think the larger risk right now to the outlook is? More of a growth shock and less of an inflation shock, as so many people were worried about, certainly as expressed in the bond market a couple weeks ago?
Well, that's how I would view it. And I don't view it as a huge growth risk. I mean, if it was a huge growth risk, I don't think high-yield corporate bonds would be one of our better performing asset classes this year. But you are starting to see jobless claims tick up a bit. Now, it's not a huge number, but you're starting to see continuing claims move higher. So we could call that maybe some cracks starting to form a little bit in the labor market. On the other side, we know prices are going to rise, but the bond market does not seem particularly concerned about it. So when I hear people say stagflation, to me, stagflation is a huge policy error in which the central bank has lost credibility. That is not what we're grappling with right now. The Federal Reserve has credibility in the bond market. What we're going to be dealing with is a unique environment where activity may be moving lower, prices may be moving higher, but the Federal Reserve is more likely to look through what they're seeing on prices and focus on growth. And that's what I would do as well. I mean, I call the Fed, they don't answer me, but nobody picks up the phone, but that's how I would operate.
I will always pick up your calls, Brian. There is this question as we set up the next 2 weeks, which will be pivotal potentially unless we get an additional 2-week extension on the back of it. But with respect to the strike or the escalation in the Middle East, with respect to the deadline for tariffs and what kind of reciprocal tariffs actually come on, and with respect to the one big, beautiful bill that could potentially increase the deficit over the next 10 years, and that will change some of where spending gets put, which do you see as the most pivotal to your outlook going forward?
I would view it right now as the trade conflict, because the market generally was surprised on Liberation Day, and we've recovered most of that amid this expectation that we will ultimately get clarity with regards to the tariff rates, and we will be significantly lower on the reciprocal tariff rates by the time we get that clarity. So it's a market that hasn't gotten back to the February 19th high, but it has grinded higher, expecting incremental improvements. And so could we go the other way on that? It's certainly possible. That's not what the market believes. That's not what precedent tells us. But that would be the big risk. The big, beautiful bill, I think we at least have a general framework for what that's going to look like. War, conflict, these things have been going on, in the world forever, and certainly since 2022, and yet the market has pressed higher so long as the conflict has not meaningfully changed the growth trajectory of the U.S. or what the central bank is going to do. So
it sounds like overweight stocks, overweight certain equities, and underweight inflation. Is that what's your sort of base case?
I would be higher quality with regards to investing, and so higher quality to me means U.S. Treasuries and high quality corporate bonds. And so investors worried about interest rate sensitivity on the one side, or a rolling over in economic activity on the other side, may be concerned with both of those views. But in this type of environment, you tend to favor quality. And that's not just in bonds, it's also in equities. And it's representative of why the mega cap growth stocks are outperforming again right now.
And maybe because a robot is going to replace us all and we can profit from them. Brad Levitt of Invesco, you're going to be sitting with us for the hour. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The White House says President Trump will make a decision on whether to strike Iran within the next 2 weeks, as you mentioned earlier in the show. White House Press Secretary Caroline Levitt says the president's goal of preventing Iran from obtaining nuclear weapons remains intact. However, she did add that if there's a chance for diplomacy, the president is always going to grab it. Meanwhile, UK retail sales fell by 2.7% in May. That's the sharpest drop since the fall of 2023 and far worse than the 0.5% dip expected by economists. The drop was led by a 5% decline in food sales and a 2.5% decline in household goods. The data suggests the UK economy could be struggling in the second quarter. And a group of Texas lawmakers are calling on Tesla to delay the launch of its long-awaited robo-taxis. The self-driving cars are scheduled to begin service in Austin this Sunday, but the lawmakers in a letter are asking Tesla to delay its operations until a new law takes effect on September 1st. Under the new law, commercial autonomous vehicles must receive prior authorization from the Department of Motor Vehicles before operating on public streets without a human driver. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Trump's 2-week window on Iran.
I have a message directly from the president, and I quote, "There's a substantial chance of negotiations that may or may not take place with Iran in the near future. I will make my decision whether or not to go within the next 2 weeks."
Andrew Bishop of Signum joining us next from New York. This is Bloomberg. No real drama in markets. Good morning. Welcome back. We are seeing a slight risk-off feel ahead of the open in futures, but it's early yet. Just down 0.2% on the S&P. You're seeing a little bit more than that on the NASDAQ. Russell 2000 outperforming on the week and outperforming today, actually up 0.1% on the heels of what we have seen with respect to a more dovish move in central banks across the world, but potentially a hint of that at the Federal Reserve. Oil, take a look at this. We are seeing increases on WTI, decreases on Brent. A question of what this means, we are not sure. Looking at Brent crude prices down 2.4%, as you do get the possibility, as President Trump has talked about going forward, that there will be some sort of more diplomatic approach. Under surveillance this morning, Trump's 2-week window on Iran.
I have a message directly from the president, and I quote, "There's a substantial chance of negotiations that may or may not take place with Iran in the near future. I will make my decision whether or not to go within the next 2 weeks. The president is always interested in a diplomatic solution to the problems and the global conflicts in this world, but he's not afraid to use strength as well.
Here's the latest. President Trump saying he will decide within 2 weeks whether to strike Iran as Israel continues attacking Iran nuclear sites, warning of Tehran's potential collapse. Trump is set to attend a national security meeting at 11 a.m. Eastern today. Joining us now is Bloomberg's Kayla Gardner. Kayla, thank you so much for being with us. Let's just start with, what is the calculus? What do we know about what is going into whether or not President Trump decides to get involved?
Well, 2 weeks. It's a timeline that we've heard many times from the president. Going back to his first term, he's used it to describe everything from decisions on health care to infrastructure. He also used it to describe another conflict, and that is, of course, in Ukraine. He previously was asked about 2 months ago whether he could trust President Putin, and he said, "I'll let you know in 2 weeks." Still yet to know whether he actually trusts Vladimir Putin. But we did learn a few critical things today or yesterday from the White House that is going into President Trump's decision. He wants to see two clear things. He wants to see an end of uranium enrichment in Iran. He also wants them to not be able to achieve a nuclear weapon at all. And at the same time, the White House said Iran already has all the components that it needs to make a nuclear weapon if it wants to. It would only take a decision from the supreme leader, and they could be able to do that in a matter of weeks, is what the White House said. But as you said, the president is meeting again with his national security team today. He has been doing that every day since Tuesday. He also has 2 other meetings on his schedule on Saturday and Sunday. And so presumably we'll find out by the end of this weekend whether the U.S. will make a decision.
Kayla, there's also the issue of the dissonance within the Republican Party, the disagreement between whether or not the U.S. should be more involved or not. Can you talk a little about how much that's factoring into the decision by President Trump?
There is really increasing political pressure on the president because this is a decision that is really dividing his base. He went into office and campaigned on this idea of being isolationist and bringing the U.S. out of wars. He previously promised to end the war in Ukraine and the conflicts in the Middle East in 24 hours on the campaign trail. So you have many of his supporters now raising questions about why he is considering even getting more directly involved beyond a defensive stance in the conflict between Israel and Iran. And he's been talking to supporters, people on both sides of this issue in recent days. And it really remains to be seen which side he's going to side with.
Kayla Gardner of Bloomberg, thank you so much for that reporting and all the reporting over the past couple of days. Joining us now is Andrew Bishop of Signum, who's been writing amazing notes, who I've been following every single day. Andrew, thank you so much for being with us. I want to start with your expectation. Will the U.S. get involved or not? And what exactly is going to tip the difference in that decision?
Yeah, hi, Lisa. So our expectation at Signum is that the U.S. will not get involved. We have about a 35% chance or so that the U.S. does get involved directly. But the reason for that is not that we think the president is, bluffing or going to chicken out. None of that. Clearly, the U.S. military defense posture is one of preparations for a real attack. There's no question. He's serious about this. The reason we don't think it's likely in terms of above 50% is if you compound the odds that Iran agrees to a deal, right? So basically, Iran fully agrees to relinquish its nuclear program, plus the odds that the Israelis are able to achieve what they want to achieve at Fordow, which is Iran's sort of last hardened nuclear site. You compound those two odds, you get to, 70% chance or so that the U.S. doesn't, quote unquote, need to intervene. And as you just mentioned right before, I don't think President Trump is sort of chomping at the bit to get involved in this war. I think he will if he has to, but only if he has to.
Meanwhile, we're hearing from the energy minister of Israel earlier this morning that Israel plans to complete the Iran task, whether or not the U.S. joins. There's a feeling we've heard from Netanyahu, the prime minister of Israel, who's come out and said that we can accomplish our goals with or without the United States. What does that look like in real terms, and how disruptive could that be, whether or not the U.S. decides to get involved?
Yeah, it's a great question, and it's sort of an opportunity to sort of recap the 3 scenarios, right? In our view, this is going to end with Iran basically without a nuclear program. And there are 3 ways you can get there. Either the U.S. does it, Israel does it, or the Iranians agree to do it voluntarily. Our base case is that, as you just hinted at, Israel is essentially going to destroy Fordow on their own. We've long said that we thought they had the capability to attack Iran on their own at a time when no one else was saying that. That has now happened. We think they're going to finish the job successfully on their own. In parallel to that, we're going to have negotiations. And once Fordow is destroyed, I think we're going to get an agreement with the Iranians to essentially put this past us. The reason I think we're going to get an agreement and Israel will also stop its attack eventually, and by eventually I mean about 10 days from now, is essentially because the Israelis, just as much as the Americans, understand that you actually need an agreement in place for the after war, right? You're going to need to be able to monitor what's going on in Iran. You can't just bomb it for the next 5 years straight.
Andrew, it's Brian Levitt here. What do you think the after war looks like? I mean, we talk about the potential. You talk about Israel perhaps being able to accomplish what they're seeking to accomplish, but what does that after war period then look like?
Yeah, so from a military perspective, the two goals are basically no more ballistic missiles. So no ability to produce them, not much by way of stockpile, no way of launching them. That's what the Israelis are working on right now, is mainly the launchers. Iran has, people always talk about how many missiles Iran has. What really matters is how many sort of launchers they have, right? And that's what Israel is really focused on. Second and most obvious is the nuclear program. Just no nuclear program, no enrichment, no weaponization program. And then the third thing, which I think you may or may not be hinting at, is this question of regime change. We think regime change in the sense of someone of a completely different ilk taking over is very unlikely. What's more likely is that Khamenei himself actually loses power and is replaced by someone else, perhaps from the IRGC, the Revolutionary Guards. To us, that's not regime change, that's leadership change. But interestingly, and I'll stop here, people are very focused on the odds of that happening during the war. So this, 3-week period, let's say. Political science precedent shows that the most likely time for Khamenei to actually lose power is after the war ends, when people really have the time to get upset.
Does that give you the sense then that this conflict perhaps becomes colder in the short term, but just continues to persist over the number of years?
Yes, I think that's a fair assessment. Israel has long had this approach of sort of what they call mowing the lawn, right? So you conduct attacks, you wipe out your enemy's capabilities. When they grow back, you come back in. That's what an Iran deal would ideally avoid. But, the word ideally is doing heavy lifting here.
Andrew, there's also the issue of how much this can continue to disrupt oil output from Iran and potentially shipping from the rest of the world. Does this take the idea of blocking the Strait of Hormuz somehow off the table, based on the fact that what you just laid out didn't really leave a lot of room for that potential?
Yeah, it's a great question. So a few things on Iran's ability to sort of disrupt the Strait of Hormuz. First thing is, just to be clear, we don't think it's likely. We think Iran is unlikely to do it because it would put a target on its own oil infrastructure's back, right? There would be a high risk that Israel and or the U.S. would attack Iran's oil infrastructure to sort of punish it for disrupting Hormuz. Second, more importantly, Iran doesn't have the ability to destroy Hormuz. It would be difficult for Iran to do in quote unquote peacetime as hybrid, a hybrid warfare tactic. It's going to be very difficult / impossible for Iran to do right now with all Israeli and American eyes on its sort of mining and naval capabilities. Third thing I would say, though, is the big risk to oil, in our view, actually comes from Israel attacking Iran's oil infrastructure, not from Iran disrupting the Gulf infrastructure. And that's not because I'm picking on Israel. It's just because if you're Israel, this is your once-in-a-lifetime opportunity to essentially wipe out the revenue source for the Iranian regime. Now, again, that's not a base case, but it's the risk we're keeping an eye on.
And maybe the reason why Iran is trying to ship as much oil as they can off their shores right now to try to maximize on that. Andrew Bishop of Signum, thank you so much, and hopefully we'll get to speak with you soon. This is really the key question, right? Ultimately, what are the roads to disruption in oil supplies that could justify some of the move that we've seen so far over the past couple of weeks?
Right, and there's two headwinds to what I would believe to be a continued rise in oil prices. One is U.S. demand is likely to moderate, and the other that we tend to forget about is the U.S. is producing more millions of barrels of oil per day now than we ever have. And so that's a big difference than where we were in the 1970s, for example.
And one reason why people say that the U.S. will be less affected than, say, a place like Europe, which has been something people have been looking at, especially with respect to how much of a tax it's going to be on the consumer. Right now in markets, you are seeing a bit of softness, but definitely nothing like the shock that we saw a couple of weeks ago. We're seeing futures lower by just a little bit. Brent crude lower when you take a look at the Brent contract, which is probably the one that you should look at since it was actively trading yesterday in Europe, and WTI supply was not as it is in the U.S. We'll be talking more about oil coming up. Stephen Schork of the Schork Group on a turbulent week for the oil market. And we're going to look ahead to what we can expect in terms of possible disruption or not, and how that really the ramifications of that throughout the global economy. This is Bloomberg Surveillance. Finishing the week a little bit on a softer tone, although this has really been a pretty quiet week, almost unchanged on the S&P 500 for the full week, although today we could bring it into negative territory, down about 0.25% in S&P futures, still above 6,000 though, so not exactly a whole lot of pain. NASDAQ futures down around the same time. Russell 2000 has really been the outperformer, which is interesting given how much those shares have been beaten up. Futures there up about 0.1%, 3 hours from that cash open. Here are your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with Circle up another 8% after a 34% rally on Wednesday. It is still gaining steam after the Senate, of course, passed that bill, giving stablecoins like Circle's USD coin a clear regulatory framework. And I will note the stock has been on a tear since Circle IPO'd earlier this month, up 540% since then. Next up, we have shares of GMS. They are soaring up 23% on some takeover buzz. The Wall Street Journal is reporting that Home Depot has made a bid for the distributor of building materials, potentially setting off a bidding war with QXO, another company which just offered to buy GMS for $5 billion. But now with Home Depot in the mix, that price tag of $5 billion could go even higher. Next up, or last up, we have Tesla. Those shares are up 1.2% ahead of its planned robo-taxi launch in Austin on Sunday. But if you thought it was going to be an easy ride, no way. That is because there's reporting out there that Texas lawmakers are asking the company to delay the launch due to safety concerns. But that potential snag is not hitting the stock just yet. Lisa?
Thank you so much, Yahira. As long as they get it out there, people will get excited about the potential for that to revolutionize the way we and our children get around. On our radar this morning, President Trump saying he'll decide in 2 weeks about whether to strike Iran. Iranian officials saying the country does not plan on negotiating unless Israel stops attacks. Brian, I do wonder whether you change anything at all based on some of the potential turmoil in the Middle East. Have you changed any of your positioning or any of your potential outlook, or put it on hold, or do you just say, we look through this because every time looking through this has been the right call?
We look through it because every time looking through it has been the right call. I mean, I always tell people, ask yourself 2 questions when conflict starts. Does it change the trajectory of the major economies of the world? Does it change what the major central banks of the world are going to do? Now, it ultimately could. We can all come up with a scenario where there's attacks in the Strait of Hormuz, where oil prices skyrocket and economies slow down meaningfully. But in its current construct, this is unlikely to change the trajectory of the bigger economies of the world or change what the central bankers are going to do. So I try to look through it, at least from a financial market perspective.
Yeah, it's such a strange thing to do, because from a human perspective, you see people's lives traumatically being affected. And then in markets, when you game it out, it just hasn't had that same kind of ramification. When we talk about that 2-week deadline, we also have to talk about the tariff deadline. There's reciprocal tariffs that are going to expire in terms of the negotiating period on July 9th. Canada opening the door to increasing tariffs on U.S. steel and aluminum next month if White House trade talks stall. The U.S. has placed 50% tariffs on foreign steel and aluminum. Canada has 25% counter tariffs in place on the U.S. Do you have the sense, Brian, that this is going to get reconciled in a way that is well below the worst case scenario, sort of around that 10% global tariff rate that a lot of people thought we'd end up with?
That's where it seems we're heading. It's hard to find people who do what I do for a living who don't believe that that's where we're heading. So I suppose that is a risk to markets. But my view on tariffs has always been that you will get less optimal economic outcomes as a result of them. They may be worth the cost if you want to defend security, if you want to defend certain industries. But to the market, what's most important is give us clarity. Let us know what this is going to look like, so then businesses and consumers can make adjustments. So I wouldn't consider it ideal, but it's a market that is currently set up for incrementally better policy than what we had feared. And so that's not that's a risk if we go the other way, but the base case, I think, is okay for this market.
2 weeks. You'll get clarity in 2 weeks. Meanwhile, we are also seeing some adoption of strategies to avoid issuing very long-term bonds around the world. Japan now planning to cut issuance of super long bonds by way more than expected. The finance ministry overnight proposing reducing issuance of 20, 30, and 40-year bonds by a total of $22 billion through the end of March 2026. The move coming after several months of record volatility in super long bonds, and it just highlights that we talk about deficits around the world and how they're whipsawing some of the long end of the yield curve, and how much there's going to be a response to this in Treasury issuance over here in the U.S. Say, back to the strategy that people in the Treasury Department have criticized that happened under Janet Yellen.
Yeah, but if you look at it, the 10-year is trading at, 4.4, and the 30-year is below 5. So we should take it with a little bit of contextualization here. But so far, the bond market auctions in the U.S. have been going okay. I mean, this has been a big story, but if I look at bid-to-cover ratios, generally in line with average. And if I were to have shut my eyes for the last couple of years and said, what should the 10-year rate be? And someone told me the real yield's around 2, inflation expectations is around 2.3, then where we are right now with the 10-year rate generally makes sense. So it's a bond yield in the U.S. that has largely been trading on nominal growth potential. Sure, a little bit of a pickup in the term premium, but nothing that investors should be overly concerned about. At this point, I hear a lot about it, the end of the U.S. being able to fund its fiscal deficits, the end of the dollar. That is not what the market is telling us.
All right, so let's turn to the other two-weeker, which is the situation with Iran and Israel. Turning to commodities, Citi warning that oil could reach $90 a barrel if the Strait of Hormuz is closed. Bloomberg's Julian Lee joins us now for more. And Julian, seems like this table being taken off the table, at least in markets, for the moment. Can you give us a sense of how big of a sea change this past month has been, where you've seen a more than 20% gain in terms of Brent and WTI crude prices, given the backdrop in the Middle East?
Yeah, look, I think that any time you get missile attacks on any country in the Middle East, particularly one of the big oil-producing countries, markets are going to spike. There is great concern over the flow of oil out of the Middle East. Whether that's around threats to close the Gulf of Hormuz, whether it's around the potential for attacks on Iran's own oil export infrastructure, or whether it's retaliatory attacks on oil infrastructure elsewhere in the Gulf from Iran, those kinds of fears all play into traders' assessments of the market. And we always get this kind of a spike in prices. Nobody's yet pricing in closure of the Strait of Hormuz. That would take prices even higher if people really thought that was going to happen. But this is the stock reaction to what we've seen happening in Iran over the last week.
Just real quick here, Julian, how much do you expect this to be the predominating story for oil for the next few months versus a passing trend in terms of concerns about the Middle East?
I think it's really going to depend how it plays out, how quickly hostilities come to an end or don't. I think, as long as these attacks and counterattacks continue, the market is going to be very focused on supply issues in and around the Persian Gulf. If there is some kind of a solution to this, whatever that might look like, then I think those fears will ease for a while. But I think that what this shows us is that we are perhaps in for a period of instability, certainly around Iran and what happens there.
Julian Lee of Bloomberg, thank you so much. Right now, joining us is Stephen Schork of the Schork Group. Stephen, thank you so much for being with us. I just want to start on how much you think these price increases will last.
Well, just as Julian said, it's going to depend on two things. A further escalation in hostilities, which seems there's a distinct possibility that occurs, and how long these hostilities remain. So at this point, we're looking at a situation of, wait and see. The market now is certainly pricing in greater volatility. What we saw leading up to this, i.e. before last Thursday, was a market that was switching into contango. Both the Brent market and the WTI market, beginning in 2026, had switched to a contango market where prices for January are cheaper for prices than February and so forth. This is a classic fundamental telltale that the market was pricing in that supply was going to outpace demand. Now, of course, with what we've seen over the past week, that situation has now moved into, well, we're back to backwardation. So now January is trading at a premium and so forth. So the market is pricing in potentially higher prices through the end of this year and into the start of 26. And that has been the real sea change in the oil market over the past week or so.
Stephen, does the world have options with regards to supply if the hostilities were to persist or if the hostilities were to get worse than where we currently are?
We're kind of limited, Brian, at that point. Iran is still a significant player in the market. This all depends on whether we're going to see a disruption to crude oil coming out of the Persian Gulf. That seems highly unlikely. The Iranians are not going to cut back their production. They actually need that production. They need that export income. Second, they're not going to close the strait, I believe, because it would alienate their two major clients, India and most importantly, China. So if you did see a disruption to this oil, then that puts China and India onto the world market, especially with China, because 90% of Iran's exports go to China. And then you have the third factor is if you do see a disruption, i.e. a cutoff of the Strait of Hormuz, you're going to alienate your OPEC brethren. So that is to say that, look, if you know your history, you know there's not a lot of love lost between the Sunni Arabs and the Shia Persians. So at this point, you're probably getting some glee coming out of the Arab world of what the Israelis are doing. Now, if you cut off the Strait of Hormuz, then you're likely to see the Arab nations kind of come from their undergrowth of pushing, or I should say their glee with what's going on, and could actually push them into hostilities. From an Israeli standpoint, they're not going to take out Iran's production because best case scenario is you do see a regime change. And the last thing the Israelis want to do is to take the ability to make money out of that new regime's hands.
Do we have a sense of what the Chinese may be messaging to the Iranians right now?
Certainly, I think that there is some reports, and I'm certainly not a military strategist, that you are seeing some planes fly into Iran. Question is there military hardware on that? But certainly, I think more obviously is they are getting pressure from China that they do want a resolution to this. They do want a free flow of oil. We've already seen oil prices jump $10 a barrel over the past, 5-6 days. So clearly, this is going to be when 90% of your oil is coming from a nation that is causing really this spike in price. There is going to be pressure coming out of Beijing to ease the situation, i.e. ease prices lower.
I wonder what the production response is going to be. I saw that in the United States, a number of oil companies had taken their rigs out of production. I'm wondering how many of those come back online in response to the increase that we've seen in oil prices rising, how much this gives a boost to some of those companies that have really lamented how low prices on oil had gotten.
Yes, exactly, Lisa. So what we saw coming into this year was a survey by the Dallas Fed of the 11th District, which is the oil price. And slightly more than half the respondents, and the survey went out to oil executives as what price do you need to see to increase CapEx. And slightly more than half of that price came in that $71 to $75 range. Now, WTI it took this process, this war, or I should say the expansion of this war, because this war began on October 7th, 2023. So you would need to see oil sustained over $75 a barrel until the industry is confident that this price rise has staying power. So at this price, at this level, there's still a lot of confusion of whether or not of how far this escalates, if it even escalates even further. So you will need to see sustained prices for, I think, at least a quarter for the market to actually, or for U.S. producers, companies to actually respond to this price level.
Stephen Schork of the Schork Group, thank you so much. Really interesting to hear how long that has to be until you get a more U.S. oil production. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with you.
Hi, Lisa. The White House has scored a legal victory over its deployment of National Guard troops in Los Angeles. A 3-judge panel ruled the Trump administration can continue using the Guard to respond to anti-deportation protests. The decision is likely to be challenged by California. And SoftBank is seeking to make a $1 trillion AI bet in the U.S. Sources telling us here at Bloomberg, SoftBank founder Masayoshi Son is looking to team up with Taiwan Semiconductor to build an industrial complex in Arizona, which may require as much as $1 trillion to execute. Facilities would focus on robots and artificial intelligence. And ending on sports, world number 2 tennis star Coco Gauff is heading home early from the German Open after a surprising loss to China's Xinyu Wang in straight sets. It was Gauff's first match since she won the French Open 2 weeks ago. 49th ranked Wang fell behind 3-1 in the second set before rallying to win the biggest match of her career. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, waiting on inflation.
What we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs.
It was like watching paint dry. It was complete success for him. Stephanie Roth of Wolfe Research joins us next. This is Bloomberg. Ending on the week on a softer note, looking at futures just lower a touch as you look to that 2-week period for so many different events to possibly transpire down 0.2% on both the S&P and the NASDAQ. In the bond space, super quiet after what we got from Jerome Powell, which wasn't a lot. A little bit higher today, but still below 4% on that 2-year yield, 3.94% on the 10-year yield, quiet 4.41%. Even on the 30-year yield, up just a touch, but 4.92%. Under surveillance this morning, waiting on inflation.
What we're waiting for to reduce rates is to understand what will happen with really the tariff inflation. What it will take is confidence that inflation is coming down. Now, I would say without tariffs, that confidence would be building. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs. Ultimately, the cost of the tariff has to be paid, and some of it will fall on the end consumer.
Here's the latest. Fed Chair Jay Powell saying tariff impacts are coming as policymakers wait for clarity. Stephanie Roth of Wolfe Research saying if tariff-driven inflation isn't visible in CPI, that would be concerning. To the extent CPI doesn't rise, that suggests someone else along the supply chain isn't absorbing the tariffs. Stephanie joins us now. A fascinating take after what we heard on Wednesday, I guess it was, where Fed Chair Powell said we will see the data change. If we don't, does that suggest that profit margins are actually shrinking considerably?
Yeah, exactly. And that would be the demise of the economic cycle. If we start to see profit margins roll over, then you start to see layoffs, and that would really become a self-fulfilling prophecy towards recession. If we end up seeing it flow through to CPI, which is very much our base case, and the consumers are likely to be able to absorb it, and we can kind of go on our way, and this could just be a fairly short shock.
Well, that really raises the issue of how the Fed considers this, because right now, based on their summary of economic projections, they do see an increase to inflation and a decrease to growth, but they don't see that as being a lasting inflation shock. Is that your base case as well, and do you think that allows them to look through that and still cut rates?
Well, look through that, yes, but the latter part, maybe not so much, and still cut rates. I think we're probably not going to see a rate cut for a while, maybe the end of 2026, realistically. The economy is likely to be okay, and this is where I would maybe differ from the projections, is the 2026 number. because I think we might see growth 2% or maybe even a little bit above as we get the impact of fiscal from the reconciliation bill, one big beautiful bill. That could actually put some upward pressure on growth, and we might be seeing an upside surprise to growth next year, which would then make it a really tough environment for the Fed to be cutting.
What do you make of the recent rise in continuing claims? Are we starting to see some cracks in the job market? And if we are, shouldn't the Federal Reserve trying to be moving ahead of that?
I mean, I think what we're seeing is a labor market that is starting to cool down, but we should see that. The labor market's been hot for quite some time. And by the way, the steady state payrolls growth backdrop has slowed down a lot. So we need to see an environment where payrolls slow down. Otherwise, we're going to be really tightening the labor market and risking even higher inflation. So it's a good thing to see the labor market cool down. The continuing claims are rising fairly slowly. It's just a gradual cooling in the labor market, which is kind of what we need to see. And as for initial claims, we're likely to see just a continued rise over the summer. So that's something I would kind of look through.
Are you as calm or as happy about seeing how sustained the inflation expectations are, how stable inflation expectations have been, not only over 10 years, but also over shorter-term time periods?
Yeah, and I mean, to be fair, we're probably going to start to see short-term inflation expectations pick up on the back of oil prices. They tend to be most linked towards energy prices and food prices, so base case is that those will start to move higher. I think it is a good sign to see that inflation expectations have been tame. Of course, they were a little bit volatile around the initial tariff debacle, but now the tariff rates are settling down, inflation expectations are cooling, and I think that's just a sign that consumers get that this is not a real inflationary spiral.
How complicated is it to understand where we are in the economic cycle, given that you see a potential for an upside surprise in growth next year, at the same time that the housing market is so flat on its back that people don't know what to make of it?
Yeah, it is an unusual cycle. It's been an unusual cycle for much of this time, where we saw an incredible recovery after the COVID pandemic. I would say, based on our models, where we model where we are in the business cycle, I would say right now we have moved towards mid-cycle. We were at late cycle. We moved towards mid-cycle. There was a little bit more slack added to the economy, which is one reason why the housing market has certainly eased. It's that I would classify as early cycle, but on balance, the economy is probably in mid-cycle. And the next year or so, we'll move towards later in the cycle again.
What does later in the cycle look like to you? How will we know?
What we'll start to see is the unemployment rate will start to fall at some point. Certainly not this year, but next year we could certainly see some downward pressure on the unemployment rate again, start to see some inflationary pressures, and then we'll be sort of lingering towards later cycle again. Call it 2027.
Which means not necessarily that the market's doing really well, but maybe that things are setting up for some sort of break, right? I mean, the idea of a really low unemployment rate that can't get much lower than what we've seen over the past couple of years, isn't that a real positive in terms of what we could get in the next 6 to 12 months?
Yeah, I mean, that's a positive. I think next year is shaping up to be a pretty good year when we're thinking about growth, earnings, markets. 2027, we might be starting to move to later in the cycle and risks start to rise again. The cycle doesn't last forever. So it is very possible at some point in the next 2 to 3 years, we end up in a downturn again.
Stephanie Roth, thank you so much of Wolfe Research for all of your contributions for Fed Day as well as today. It feels like it's been a rolling 2-year cycle, just the way it's been a rolling 2-week cycle in terms of when the cycle will end. I mean, at what point do you look at all of this and say, this has been an economy that's been incredibly resilient and should be able to prove that it is once again?
It has been an economy that's been incredibly resilient. And I tend to get more worried about being later in the cycle when there's a lot of leverage and excess in the economy, which does not seem to be the case. We did get an inversion of the yield curve, which hurt small businesses, hurt different parts of the economy. But if you look broadly, the next things to look at are credit spreads blowing out, are bankers tightening lending standards. We saw a bit of that here and there, but that's not where we are currently.
Although the leverage is in governments, which is the reason why people are watching a lot of the government auctions.
but not showing up at the business side, and the banks don't appear to be over levered.
Which is the reason why people are wondering whether you could end up getting corporate spreads that are inside of where we see government bond yields based on the better profile. Brian Levitt of Invesco, thank you so much for spending the hour this morning. Coming up next, Dan Greenhaus of Solus Alternative Asset Management, Bloomberg's Akela Gardner, Tom Nides of Blackstone, as well as former Kansas City Fed President Thomas Hoenig, as we look ahead to the next 2 weeks, which should be rather eventful. You're watching Bloomberg Surveillance.
back to where we were in January with a different set of risk and a different set of facts, which look worse.
When you look at this year, markets have gone through the entire range of emotions.
Yes, the market is very resilient, but yes, it's very well aware of what's going on.
There's clearly signs of softening, but everything's been very low grade.
The macro picture for now is still not too weak.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance as we look to a rule of 2 weeks. 2 weeks on a decision on whether the U.S. directly strikes Iran. 2 weeks until the tax bill is due. 2 weeks until the reciprocal tariff deadline. Danny Berger joining me for the next 2 hours. John and Annmarie are both off today. It feels like we're going to learn a lot in the next 2 weeks, but for now, it feels like we remain in the dark.
We're in the dark, but there's so much noise in the meantime, coming from geopolitics, coming from politics in general. But maybe what's the loudest has been the silence from this market. For this week, for stocks, it's been the tightest trading range since January. For bonds, the tightest trading range since December. There's not a lot of movement with a lot of the risks that you're highlighting on the horizon.
There's a lot of exhaustion right now as you take a look. S&P futures lower by about 0.2%, but you're right, on the week, basically flat. NASDAQ futures down about the same. Russell 2000 outperforming, and perhaps the reason why is in the 2s, 10s, 30s bond space. You see yields somnolent this week, also basically going nowhere today, up about 3 basis points on the long end, but still quiet, 3.94% on the 2 years. People look to dovish central banks around the world, really giving a boost to this idea that central bankers are looking past the potential inflationary hit and towards some sort of growth shock.
We do have a timing issue here. There was a really interesting study from the Danish Central Bank recently saying, looking at all the trade shocks from the 1990s, it takes at least a year for the economic effects start to filter in. So you get this feeling from the Fed, maybe they want to wait and see how inflation plays out. September has been made the timeline. Maybe we won't even know the real effects in September. It might take longer than that.
In the meantime, you are seeing, though, the Bank of England not necessarily move, but signal they are going to be cutting rates. The Swiss National Bank looking at negative yields again, cutting to zero and signaling that they'll do whatever it takes to get people to stop going into the Swiss franc. And you have this idea of even the Norges Bank coming out with a rate cut, a sense that globally there is a feeling that the inflationary shock has abated.
It has abated. Again, for how long? There have been reports of stockpiling, and that means that the narrative of higher inflation comes longer on. One that is likely happy about this are governments, our fiscal policy. You see the likes of Japan this morning, for example, saying that they're pulling back on ultra-long bond issuance. The demand has been waning because of the uncertainty around inflation, because bond yields keep ebbing higher and you keep seeing losses there. So some of these cuts maybe will start to filter through and create more demand for bonds when policymakers need it so badly.
Yeah, this is a reason why people are maybe saying, or people being President Trump saying, look, if you cut rates by 2 basis points or 2 points, we're going to end up with much lower borrowing costs in the United States. So get on it, Jay Powell. And Jay Powell says, listen, I am not your guy. I am just doing my job. Coming up for the next hour, Dan Greenhaus of Solus Alternative Asset Management with stocks on hold. Former U.S. Ambassador to Israel, Tom Nides, as President Trump gives Iran time for diplomacy, and former Kansas City Fed President Thomas Hoenig as Trump lays into Fed Chair Powell yet again. We begin this hour with stocks muted as President Trump buys time in the Middle East. Dan Greenhaus of Solus writing this. Things really ramp up with tail risks becoming reality and oil approaches triple digits. Otherwise, markets are in a bit of a dead zone until the next jobs report. Dan joins us now to talk about that dead zone. Dan, thank you so much for being with us.
Thank you for having me.
It feels like, why would anyone get long risk right now, heading into this weekend, given the fact that a lot of things could change and it's very hard to really get an edge on it?
Yeah, the quote you just read is sort of I did a poor job of articulating what I was trying to say in a larger sense. But the triple-digit oil scenario is in a worst-case scenario, if you will, where we end up bombing the Iranian nuclear facility and things spiral a bit out of control. And so from a trader standpoint, you are certainly a little reluctant to be long risk into a weekend when something like that can happen. Although, admittedly, you're probably taking some comfort from the president saying, yet again, a decision will be made in the famous 2-week time frame. So perhaps you think, okay, well, maybe not this weekend, but at this point, we're living through a moment where any time in the next 24, 48, 2 weeks, you could have an attack on that facility. And to be clear, I think all the foreign policy reporting is that all the tools are in place for that to actually happen. The question is, at this point, just a matter of when.
There is a question also of just whether we do get clarity in the next 2 weeks. There's been sort of a rolling 2-week time frame that we keep getting. Yes, it'll show up in the data, maybe in 2 weeks. Yes, it'll show up in some sort of policy decision in the next 2 weeks. At what point do you count on clarity, or do you say, you know what, this is the new normal? We're going to go into what we know, and we're going to basically stay away from whatever we don't?
I think for now, I think you said on the show the other day, the only certainty right now is uncertainty, or the scarcest commodity is clarity. Someone said something like that. It was really terrific. I think some version of that sentiment is true. The 2-week time frame I do disagree with. I mean, the situation with Iran is going to be with us for a little while. Obviously, bombing or not bombing, we'll know when it happens. But the larger story about tariffs is going to be with us for a while. I have disagreed with people who have taken total comfort, as you alluded to in the opening monologue, that for now the tariff story is not played out, and so markets are at a high, spreads are at their tights. The story from my standpoint was always going to be in the middle to end of the summer. So it's when you get the July inflation report in August or the August inflation report in September, you're going to have a lot more clarity by then. Until then, my argument for being long risk assets, as we were selling off, is you're not going to have that clarity, or at least the first inclinations of that clarity, until later in the summer, in which case, why are we down 20% off the highs? And so I disagree with not that you said this, but I disagree with the idea that 2 weeks is the time frame. I'm operating more in the next 2-month time frame.
If we get something in the 2 weeks that looks like U.S. involvement, it maybe is a shock, but it's another one of these shocks that I don't know if we can count it as such, because a shock is supposed to be something you don't see coming. And we keep getting a lot of that, be it geopolitics, be it coming from the White House, be it policy. Does that mean for these types of shocks, I'll keep calling it, how we trade it and how we treat it is different than how we usually did in the past?
That's fair. That's fair. The fact that we're all waiting for some explosion, and when the explosion comes, doesn't make it any less shocking. I mean, I asked my wife out. I thought she'd say yes, and she did. I was still fairly shocked. She's quite fetching. But that issue, I think from an investor standpoint, whether you're in credit or equity, structured products or commodities, we're all sort of looking at the same thing, which is, when is this going to happen? Is it going to happen? And what are the effects? And there are really 3 things that you're wrestling with now. One is what looks likely to be happening right now, which is just the status quo. Ongoing hostilities, skirmishes here or there, et cetera, and oil in particular holds at this mid-70s level for a prolonged period of time. How does that operate? You've already seen retail gasoline at the pump tick up. It was $3.10, $3.12. Now it's $3.20. So consumers might, for the moment, pull back. Another scenario is that clearly nothing's going to happen, and oil is going to probably fall back into the mid to low 60s, if not further, over time. And then the tail risk scenario, to the question about being long risk into the weekend, is that we bomb Fordo, and they attempt to close the strait. And while I think there are fair questions about the Iranians' ability to close the strait if they tried, the attempt to do so is going to be good for $100 oil. And that was the point I was getting at earlier. And then what does the risk landscape look in the short term? Again, I think the longer term issue is Iranian forces are probably not going to put up too long of a fight against the U.S. and Israel, the combined forces. However, in the short term, are there missiles lobbed into Saudi Arabia? Do they attempt to close the strait and hit a ship or two? Those issues are what you wrestle with, and could lead to, certainly would lead to some destabilization in the short term.
I mean, that is a fat, ugly tale. But do you understand what oil would do? Do you understand what other risk assets would do? How prolonged any sort of weakness there would be, given the very short bouts of weakness we've seen this year?
I mean, you can build a framework for historically what happens during the situations when oil jumps up by $25, call it 25%, 30% in short periods of time. Equities will probably be down 10% off the highs, if not more. Gold will spike, et cetera, et cetera. You can build a framework for what that's going to happen. The problem is, from an investor standpoint, is you really have 2 different types of investors here. One is, oh, this is fun, I'm going to try to exploit these issues. And then there's a whole chunk of us that are like, well, I invest over longer time frames. I put money to work in companies, we invest in the companies, we lend money to companies for 3, 5, 7 years, in which case what happens over the next 3 months in the oil market is largely irrelevant.
So basically, some people are saying this is fun, and then the rest of you are saying not so much. Can you give us something to actually work with? Let's talk about what we actually do know. Yep. Because I was looking this morning and thinking, okay, there's a lot that we don't know that's going to be decided in the next 2 weeks. But there's some things that we have learned in the past couple of months. Number one, AI is still here, robots still threatening to replace us, and people who can program them, create
they're not
them,
replacing
envision them. All right, let's just leave it alone. But et cetera, are going to be paid $100 million bonuses and are in great demand. Okay, that is still something that we're seeing profitable. We're also seeing that central banks globally are leading to the dovish side. And that is notable.
Yep.
And it is led by Europe, not the U.S., which really threatens the whole dollar trade. But I'll leave that aside for just 1 second. A real question of how much that gives a tailwind, certainly to markets overseas. Yes, we don't understand what's happening on the geopolitics, but how much do those two themes alone send you more into certain risk assets that you can count on because you can bank on these particular threads?
So we've talked about this in the past, and any number of other people have as well. The AI story, I think, clearly is here to stay. And whether it's NVIDIA or Broadcom, et cetera, for a year now, 2 years now, there's been a little smoke. You've had, we're not going to invest in that data center as much. The DeepSeek Monday was a moment. But the CapEx story remains in place. The investment story remains in place. And to your point about the $100 million bonuses, which, by the way, I don't believe that. But
really, you would take it, right?
$100 million bonus?
It's okay. You don't have to answer. I mean, anyway, if Solus, he's doing great.
So how do you know Solus isn't giving me $100 million?
All right. Carry on.
They're not. But that story is still an important theme in markets. And when you look at the factors that have worked this year, size across spaces has been one of them. And I'm looking now, Microsoft is up 14%, NVIDIA is up 9%, Meta's up 19%, basically at a high. The only one of those big names that's not working is Apple, because the street generally views them as having missed, at least thus far, the AI trade entirely. Now, we'll see in the fall whether that's the case or not. But that theme is wholly in place in the market. You see it in utilities are the third best performing sector. That's because of Constellation and Vistra and the deals with Amazon and Microsoft. So that story is wholly in place. The replacing us, man, I know everyone's talking about this.
Yeah.
I saw a debate the other day, the 30-hour work week that was predicted 100 years ago is finally. No. I don't think that. The history of the United States and productivity-enhancing technological advances. The cotton gin is the one everyone uses, but what about the ATM machine or the computers in the 1990s, et cetera, has always resulted in just a reorganization of the economy, not a replacement of the economy. And I was just reading Chip War, the book about, obviously, semiconductors, and he was talking at one point about all the women that were employed connecting the wires into the wall. That obviously was replaced by switches, by Cisco, and all those people had to find new jobs, and they did. And I can't imagine that this time is not going to be different. The idea that we're all going to be sitting around playing tennis all day, Danny.
I feel attacked. It's okay.
Worrying about how we're going to kill 40 hours or 100 hours a week, no matter how much you work. I think that's science fiction, at least for now.
Right now, I will just say this is the topic of discussion in my household. And one family member was saying, I want to invest in robots that treat us like rich pet owners treat their dogs. So I have to wrap my head around that and look for that company down Greenhaus, Solus Alternative Asset Management. You don't have to respond to that. You will be sticking with us right now. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anna and Yahira.
Hi, Lisa. The White House says President Trump will make a decision on whether to strike Iran within the next 2 weeks. White House Press Secretary Caroline Levitt says the president's goal of preventing the country from obtaining nuclear weapons remains intact. She added, however, that if there's a chance for diplomacy, the president is always going to grab it. Meanwhile, Pop Mart shares tumbled in Chinese trading after state media called for stricter regulation of blind box toys and trading cards. China said some business models induce minors to become addicted to purchasing these products. The warning did not call out Pop Mart by name, but the company is well known for selling those blind box toys like its popular toothy monsters, Labubu dolls. And a 16-year-old restaurant in Lima, Peru, has been named the best in the world. Maido specializes in Nikkei cuisine, which is a combination of Peruvian and Japanese flavors. The top 5 restaurants on the list are located in Peru, Spain, Mexico, and Denmark, with Italy and Bangkok having a strong presence in the top 50. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. What didn't have a strong presence was the United States, with just one restaurant, I believe Atomics, in that top 50.
It's okay, we got a Pope, so we don't need the top 50 restaurants.
There you go. You heard it from Danny Berger. Up next, a rift in the GOP.
The Senate needs to recognize they can make changes, they can enter into negotiations, but the fact is you need 218 votes to pass this in the House, and there is not a chance in hell that this bill will pass at $10,000, let alone less than $40,000.
The SALT contingent is going strong. Bloomberg's Kayla Gardner joining us next. This is Bloomberg Surveillance. Finishing up the week on a little bit of a softer note, but as Danny said earlier, this has been one of the tightest trading ranges all year that has ended the week potentially almost unchanged. Right now, we're down about 0.2% on S&P futures. We are seeing a little bit of a sell-off in the bond space with that reprieve of 2 weeks, maybe, to make a decision, up about 3 basis points, 4.42% on the 10-year crude prices. In New York, up a little bit, but on the Brent contract, you can see a decline as that sigh of relief does continue. Under surveillance this morning, a rift in the GOP.
The Senate needs to recognize they can make changes, they can enter into negotiations, but the fact is you need 218 votes to pass this in the House, and there is not a chance in hell that this bill will pass at $10,000, let alone less than $40,000. I guess people, want to try and call our bluff. They tried that in the House. They tried to jam us, and we didn't fold.
Here's the latest. The battle within the GOP rages on as the big, beautiful bill's deadline nears in, guess what, 2 weeks. Joining us now, Bloomberg's Kayla Gardner. Kayla, how much are we seeing fissures that threaten to really derail the July 4th timeline for the one big, beautiful bill?
So the issue that you saw Congressman Mike Lawler talking about there is the SALT tax. The threshold that was passed in that House bill was $40,000. And in this Senate version of the bill, it's as low as $10,000. So there's deep disagreements, between Republicans in both of these chambers, particularly because they say it's an issue of fairness. This provision essentially allows filers to reduce the amount of taxes that they owe on their taxable income by the amount they already paid to state and local government. So that means a lot for people in places like New York, California, the suburbs of Washington, D.C., who make wealthy amounts of income. And yet you have people, Republicans in states that are lower incomes, saying this is unfair, that they feel as though their constituents are subsidizing this issue. There's also other risks. One is Medicaid. You have the Senate bill having deeper cuts to Medicaid. Basically, there could be millions of Americans who lose their coverage under the House bill and the Senate bill that has basically even more thousands of people that could lose that bill. And then, of course, there's the deficit. You have hawks in both the Senate and the House, and there's such a delicate balance. You saw that House bill take weeks to negotiate, and this Senate bill still has to go back to the House before it can be fully passed.
Kayla Gardner, thank you so much for that update. Dan Greenhaus of Solus Alternative Asset Management still with us. Dan, how much downside potentially is there in markets if this bill does not get approved, passed by that July 4th deadline?
An enormous amount, but I don't think that's very likely at all. The bill is passing. The only question is in what form. The TCJA was such a important bill at the time. It remains, obviously, President Trump's signature legislative achievement, and the idea that this would not pass is fanciful as far as I'm concerned. So the only question is, we know we're not going to have a $40,000 SALT deduction. We know we're not going to have a $10,000 SALT deduction. So the only question is whether it's $20,000 or $30,000. And then the rest of the stuff is, I don't want to say tinkering. Obviously, the Medicaid issue and the Medicare issue is a problem for a number of senators, Josh Hawley perhaps most prominently, but they're going to work this out. And we go through this every cycle when there's debates, whether it's with Democrats or Republicans, intra-party squabbles. We're watching the sausage get made, and so when you watch the sausage get made, you go, oh, that's gross. But then in the end, after 3 to 5 minutes on each side on the grill, the sausage is quite delicious. And I think that's what's going to happen this time as well.
George Surveillance of Deutsche Bank hasn't been talking about the deliciousness of the sausage, but has instead been saying whatever sausage gets made, it's what we're stuck with for at least a decade, because you're going to have the midterm elections, likely see more division in the House and Senate between the split of lawmakers there. The reconciliation process is very difficult. So what we get this time around is set in stone. Does that increase the risk of when you have expanding deficits, that it's going to be with us for some time, and it's harder to do an about face if it is a market that starts to push back against it?
Yeah, of course. The U.S. government is to some degree designed to be sclerotic. There's no doubt about that. And that in many times is quite helpful. The government that governs least governs best. And I generally subscribe to that view. There are times where you need to do things. And I think the longer you delay, not I think, clearly the truth is, the longer you delay the inevitable fixing of our budget and spending issues, the worse the adjustment is going to be. And it really is a crying shame that we can't figure out some way. We're going to have a $2 trillion deficit next year in an expanding economy with essentially a record low unemployment rate. That is remarkably bad. We should be something close to a balanced budget, if not an outright surplus. Obviously, we've only had surpluses for a brief period of time in the late 1990s. But like, it is just an absolute. I don't even find the word. I can't believe Congress can't figure out how to, over the next 4 years, reduce that deficit. And it can be done. To be clear, this isn't brain surgery. The problem is, as my favorite saying goes, everyone knows what has to get done, just nobody knows how to get elected once they've done it. And it really, listen, it is a mid-single digit call, 6.5% of GDP budget deficit. Getting to zero is going to be incredibly difficult by the end of the president's first term. Could I get you to 3% or 2%? I think I could. Now, again, I have the luxury of saying that from this overly air-conditioned studio here in New York and not from having to get elected in Washington. However, it can be done, and we're not doing it. And when we do finally have to be forced to do it, presumably by the market, it's going to be way more painful than it would be had we do it now
Do you
electively.
really believe this is a market that's going to force it? I mean, even things like auctions have been totally fine. Treasury holdings haven't really diminished that much against foreigners. For all the fear of a buyer's strike, it hasn't materialized.
To be clear, I'm not insinuating it's going to happen today, tomorrow, or the next day. This is the bond market has proven for long periods of time to not care about this stuff. And if you look at the Japanese market, obviously their debt to GDP dwarfs what ours is, and not that the Japanese economy is one we should model ourselves against, but they haven't had a bond buyer strike there. Granted, a lot of that debt is held domestically, and increasingly some of ours as well. So no, I don't think the deficit matters. And I have this fight with people internally at Solus, and I used to at BTIG as well. People would go, oh, how is this? Who's going to buy the 30-year? Everybody. There's clearly no problem with this, and I think this will be one of those Greek moments where it doesn't matter until it does, and I have no ability as a market strategist or market economist to forecast that. So advocating investment strategies around the inevitable is farcical, because I have no way of knowing when it's going to happen.
All I hear from you is take the summer off. That's just my sense. But Dan Greenhaus of Solus Alternative Management,
Worse advice has been given.
Yeah, I'm just saying, I don't think that that's such a terrible idea. That's essentially what Jay Powell was saying on Wednesday.
He might as well have taken the day off on Wednesday. I think in 2025, that's a great accomplishment, though, to be boring and to not move the markets. I think in this day and time, it's a great thing.
It was a raging success. Dan Greenhaus of Solus Alternative Asset Management, thank you so much for spending time with us this morning and for not taking the day off. We appreciate it. Honestly, this has been something that we keep talking about, that why make any big moves in this market? But it does feel like we have learned something with respect to the resilience of different companies. And CarMax actually came out with earnings this morning that also beat estimates because people are buying used cars. Again, the resilience keeps on being that theme.
I was really shocked by when we spoke to Dan Skelly earlier this week, saying only 10% of companies had incorporated some tariff downside into their earnings. How much of that is that there isn't that much downside, or that they know they'll get punished for doing so in this market?
Yeah, it's a great point. The idea of how much is messaging and how much is in reality they can adapt and they can adjust. Coming up, former U.S. ambassador to Israel and vice chairman of strategy and client relations at Blackstone, Thomas Nides. He will be joining us next as we look at markets a bit on edge ahead of the weekend. This is Bloomberg Surveillance. Finishing up a quiet week with a quiet day as we wait for some sort of understanding of what's going to happen between Iran and Israel, how the U.S. may or may not get involved, as well as, of course, the 2-week deadline for the trade negotiations, as well as the tax bill down in Washington, D.C. Futures lower by about 0.2% on the S&P and NASDAQ. Russell 2000 doing much better, up about 0.5%, as people take a look at the likelihood of a more dovish central bank regime in the weeks and months ahead. 2 hours away from the cash open, here is your morning movers with Yahira Anand. Yahira.
Hi, Lisa. We start with the largest used car retailer in the U.S., and that is CarMax. It just reported earnings, and shares are up nearly 10% because the results were solid. It posted higher profit and higher sales in the first quarter. Not a surprise at a time when shoppers are looking for ways to avoid tariffs. And of course, buying a used car is one way to do it. Next up, we have shares of GMS. They are soaring up 28% on some takeover buzz. The Wall Street Journal is reporting that Home Depot has made a bid for the company, which distributes material products, potentially setting off a bidding war with QXO, which just offered to buy GMS for $5 billion. Of course, now with Home Depot in the mix, that could set that price tag even higher. And we end with Smith & Wesson. Those shares are tanking down 13%. The gunmaker reported results after the bell on Wednesday, and the results were not good. It says that it will face another challenging year as demand for its guns continues to cool. That's because it says broader economic issues like inflation and tariffs are making customers think twice before buying their guns. Lisa?
Thank you so much, Yahira. On our radar this morning, President Trump saying he'll decide whether to strike Iran within 2 weeks, leaving room for negotiations. This, as Iran says, it won't come to the table as long as Israel continues striking the country. Danny, this is the will they or won't they scenario that's keeping a lot of people on edge.
Trump leaving the door open for diplomacy, but even just what you're suggesting there, is diplomacy really an option? Does the U.S. have the sway to tell Israel to stop attacking Iran if that's the terms and conditions for Iran to actually have some sort of negotiation? We know what Trump wants is total surrender. It's also hard seeing Iran do that. They need some sort of face-saving operation domestically when nuclear ambitions have been part of, again, domestically, their operations going forward. So how do they give that up? They're meeting with European ministers today. Does Europe even have sway? So there's a real question as to what form diplomacy can take at this moment.
Yeah, in the meantime, people are trying to game out exactly what it could look like in markets, with some saying oil prices could jump to $90 a barrel if the Strait of Hormuz is closed. That's according to analysts over at Citi. About a fifth of the world's daily oil output passes through the strait. Citi adding that a prolonged halt to the shipping through that waterway is unlikely. And Danny, that's what we keep hearing. Why would they shoot themselves in the foot? Not only with their own income, but also with some of their neighbors in the region who would not be particularly happy if they did this.
And not just their neighbors, but China, too. 90% of Iran's oil exports goes to China. It's one of their few friends in this moment right now. You could argue, well, maybe there's a risk from the Israeli side. But of course, if Israel does something to close the strait, that would upset the Americans. I should just say the risk is there. There were two particularly hawkish members of Iranian parliament saying that this is a real option for them, threatening directly to close the Strait of Hormuz. So threats have been made, but there are real constraints to doing so.
How much does it feel like people are just kind of exhausted in markets and gaming out the worst case scenarios? Because we've had a lot of them over the past couple of months, and not a lot of them have come to fruition. So at a certain point, it feels like people aren't willing to really acknowledge the worst case scenario since they've gotten burned again and again and again.
It's so true. The noise has become deafening and made it silent for the market, but it almost kind of feels like death by a thousand cuts. You keep getting disruptions and you can say, I'll ignore this one, I'll ignore this one. At what point does it add up and create real issues, be it a consumer who doesn't want to buy because they're concerned where things are going, or a global economy that actually starts to feel inflationary impacts?
Great point, and it brings us to what we've also been focusing on, which what have some of the implications been for some of the commercial partial segues, given the fact that we have seen tariffs and they have made a material impact on how people get goods. U.S. tariffs taking a major toll on Chinese exports in particular. Small parcels shipped from that country to the United States dropping by more than 40% in May. The disruption fueled by the end of the de minimis exemption, which had let packages valued under $800 enter the United States duty-free. It just is a reminder that things have changed and that there have been real-world ramifications from some of the tariffs that, yes, are still getting negotiated, but are still on also.
Right, and these are cheap goods that are no longer finding their way to the U.S. And the logical conclusion is that if people wanted to buy these sorts of things, they're either not buying and demand is pulling back, or they're buying it elsewhere and paying more for it. I was talking with a company that supplies Amazon and Costco for furniture products, and they have warehouses in the U.S., and they said that Amazon and Costco completely cleaned out their warehouses. They bought everything they possibly could with prices that happened before tariffs were put on. At some point, these companies are going to restock. What does that look like? How much higher do prices go? At some point, you'd imagine we will see tariff impact.
And that's the reason why Fed Chair Jay Powell said he is on hold to understand what those impacts could be and will be to CPI. Turning now back to our top story, President Trump expected to make a decision on striking Iran within the next 2 weeks, saying there's a substantial chance of negotiations in the days ahead. Joining us now is Tom Nides, former U.S. ambassador to Israel and vice chairman of strategy and client relations at Blackstone. Thank you so much for being with us. Tom, I want to start with the idea of Israel's endgame, given your experience working with them. Do you have a sense of what they would like the outcome of this conflict to look like?
Well, first of all, thank you for having me. And it's very simple: to eliminate the threat of a nuclear Iran to attack Israel. It's not much more than that, and that's a pretty big deal. Think about what Israel has gone through the last 6-7 days. 400 and plus ballistic missiles have been shot into Israel, into their cities, in both north and south, and into Tel Aviv and to Jerusalem. 400. If one of those ballistic missiles had a nuclear warhead, think about the impact would be on the state of Israel. Now, you would say, well, is that possible? The Iranian regime has been very clear to Israel that their goal is to destroy Israel. So you have a country who wants to destroy Israel and trying to develop a nuclear weapon to do so. And I think it's important to understand, too, that I think, as you know, I don't usually agree much with President Trump, but I do agree that diplomacy is the key here. If we can force the Iranians to the table for a diplomatic solution, in my humble view, that is the best thing that we can accomplish.
Tom, how difficult will that be to do, though? If President Trump and Israel's aims is a nuclear disarmament, and just from what you were saying, it is part of Iranian policy domestically to completely wipe out Israel, and part of that aim being doing so with nuclear weapons. Are we really going to get a scenario where Iran can be convinced to completely disabandon their nuclear ambitions?
You know, listen, as you know, I spent my career both in government and in business. And like in any negotiation, it's a negotiation. I think, as you know, there was early on during the Obama administration, the JCPOA, which was a negotiation. Obviously, it was changed and ripped up during the Trump administration. The Trump administration now is faced with a clear decision. And I think President Trump is correct in trying to get these parties to the table. You know, you get to the table when you look around and you determine there's no options. The Israelis have done a very significant job of eliminating some of the threats of the Iranian regime, specifically around their ballistic missiles, but also part of their nuclear program as well. So now the option is for the Iranians to decide, is now the time to, as they refer to it, is to cut the deal. And if not, then the Trump administration has another much more difficult decision to make.
So if we get to that difficult decision where you can't get a deal cut and the U.S. starts to participate in the strikes against Iran, Tom, we've seen in past conflicts that things that start with, let's call it low risk, just bombing campaigns on the air, quickly develop into something different if those aims aren't achieved and face needs to be saved. What is the risk this time around that if the U.S. does get involved, that does spiral and they need to get more heavily involved?
Well, that you just hit the nail on the head. This is, the conversation we would have in the Situation Room during both the Obama administration and the Biden administration. The reality is the same conversation they're having right now in the Situation Room in 1600 Pennsylvania Avenue, which is nothing is simple. The reality is everyone says they can drop this Buster bomb on Fordo and it'll all be great. That doesn't always work that way. As you know, it could be multiple bombs. It could have ramifications in the Middle East. We have lots of troops all through the Middle East. So nothing is simple and nothing is easy. And I know why the president is asking for more time. He wants to try to figure out if he can put pressure on the Iranians to have a negotiation. Now, again, I think it's clear we have the ability to do an enormous amount of damage to the Fordo site. And I think the president will use those abilities if they cannot get a negotiated settlement. By the way, Democrat and Republican administrations alike have said over and over and over again, will not let Iran obtain a nuclear weapon. This is not a partisan issue. This is not a liberal versus Republican. It's how we get there. And listen, as someone who's spent a lot of time in this, would I like to get there through diplomatic means? With 100%, to avoid exactly what you're saying, the ramifications of doing this militarily.
Tom, to quote what Dan Greenhaus of Solus was saying just a bit ago, there's how the sausage is made, and we're all learning about how the sausage is made on a number of fronts of the policymaking world, not only when it comes to negotiations between the U.S., Israel, and Iran, but also just generally with trade. This uncertainty has left a lot of people wondering, for companies that you advise every day, how they handle that, how they decide whether to move forward. How many of them are saying, we are sick of pricing in all the worst case scenarios. We're going to just keep on going with our plans. We're going to make our acquisitions. We're going to do our business and just deal with the potential challenges as they come up.
Well, as John Gray says, who I work with very closely, this is tariff diplomacy. We're in the midst of that right now. The president is using tariffs in a way to level, as he'd like to say, level the playing field. We're at the beginning of this. As frameworks get announced, as deal gets cut, as you all know very well, these are very complicated transactions. And I think, this is why, again, from a Blackstone perspective, we have a lot of dry powder. This is a good market for us as investors, given the fact of the uncertainty. We're investing for the long haul. We're not investing for the next 12, 24. We're next 3, 5, 7, 10 years. And so in a time of uncertainty, something for us is looking through this and try to make those business decisions based upon what the future is going to hold, not what the current situations understand.
That said, Tom, and this is actually raises a question, especially if you've got a lot of dry powder. Are you waiting for some uncertainty to percolate into markets? Are we pricing in any uncertainty right now at all, so close to all-time highs, and given some of the valuations that we're seeing in private markets?
Well, listen, as we all know, the markets are volatile. We're going to be in a very volatile situation until, obviously, the Iranian thing resolves itself, until it gets some clarity around the tariffs. Markets will go up and markets will go down. But I think ultimately, we have concluded at Blackstone, there's some very good neighborhoods out there. We're investing, as we see them, not only through our abilities to invest through private credit and through our different private equity. We're looking in a very clearly that the markets over the long haul will be quite healthy, and we intend to invest during these periods of time.
Tom, has companies' abilities to adapt to shocks also changed? We're getting a lot of them, be it through politics, be it through geopolitics at this moment. As consumers start to express uncertainty, do companies have better levers this time around to preserve margins, to keep business flowing?
Yeah, I think that they do. And I think also, listen, when you have institutions like us with an enormous amount of capital, we can help make sure the runway is foamed up, as they like to say. So, yes, do I think that there is companies are adapting? Listen, we're about ready to face an enormous amount of constraints around AI and what that will do to businesses. But I think we are as a country and as business very capable of looking at these activities and investing through them. And I think that's what's important. I think it's, as your viewers look about the uncertainty, markets are always uncertain. I mean, again, I have spent my career in both of these worlds. And every week there's some new element that you have to adjust to. And that's okay, because it keeps It keeps us all employed, and it also keeps it somewhat interesting.
Until ChatGPT takes over. Former ambassador, U.S. ambassador to Israel and vice chair of Blackstone, Tom Nides, thank you so much. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahaira Anna and Yahaira.
Hi, Lisa. Israeli officials warned residents that Iran is hijacking private security cameras to gather real-time intelligence. Earlier this week, a former Israeli cybersecurity official warned residents to turn off their home surveillance cameras or change their passwords. Meanwhile, Temu's weekly sales dropped more than 25% compared to a year ago. This as the retailer cut spending on advertising targeting Americans, marking a shift after President Trump's tariffs. Temu's sales declined, contrast with other e-commerce platforms like Shein and Walmart, which have all returned to year-over-year growth. And a group of Texas lawmakers are calling on Tesla to delay the launch of its long-awaited robo-taxis. The self-driving cars were scheduled to begin service in Austin this Sunday, but in a letter, lawmakers asked Tesla to delay its operations until a new law takes effect on September 1st. Under the new law, commercial autonomous vehicles must be cleared by the Department of Motor Vehicles before operating on public streets without a human driver. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. I don't know, but I'm actually excited about the idea of being driven around by just, the car.
I would love that. I would also love putting my parents in a car like that, too, and not worrying about them. And for my future children, I'm sure you feel this way, too. Yeah. That's great.
I know. I think it's great. And I wonder if your parents are listening. Up next, Powell's biggest critic. Powell's biggest critic.
So we have a stupid person, frankly, at the Fed. Maybe I should go to the Fed. Am I allowed to appoint myself at the Fed? I do a much better job than these people. So anyway, we should be 2 points lower.
Former Kansas City Fed President Thomas Hoenig joins us next. This is Bloomberg. Well, we had been starting on a soft note. It seems to have turned around a little bit as people really game out what the likelihood is of the U.S. getting involved in some sort of Iranian strike. Up 0.2% on the S&P futures. You're seeing that lift really continue in terms of 10-year yields higher on the heels of that risk-on type of move, 4.43% on that 10-year. And Brent crude, the contract you want to be paying attention to, given the fact that it was trading yesterday as well, and so it's actually a fair comp, lower by 3.5%, $76.06, as possibly the diplomacy could rule the day. Under surveillance this morning, Powell's biggest critic.
So we have a stupid person, frankly, at the Fed. It's a political guy who's not a smart person, but he's costing the country a fortune. So what I'm going to do is, he gets out in about 9 months. He gets fortunately terminated. Maybe I should go to the Fed. Am I allowed to appoint myself? I don't know. Am I allowed to appoint myself at the Fed? I do a much better job than these people. So anyway, we should be 2 points lower.
Here's the latest. President Donald Trump continuing his criticism of the Fed chair, writing on Truth Social, "Too late, Jerome Powell is costing our country hundreds of billions of dollars. He is truly one of the dumbest and most destructive people in the government, and the Fed board is complicit." Joining us now is former Kansas City Fed President Thomas Hoenig. I'm sure, Thomas, you don't really want to comment on that in particular, but it is important to understand exactly how the Fed is navigating this. Do you think that they're making the right decision in just being as plain, as boring as possible and holding on for the data?
Yeah, I do. I think they're doing the right thing. They're being cautious. There's so much uncertainty, as you all have talked about. There's geopolitical uncertainty. There's economic uncertainty. There's the budget that hasn't even been decided yet, which I think will have a big impact on the economy. And the Fed won't talk about that themselves, but that is being talked about. So there's so much. I think holding steady, and there's a lot of liquidity still in the market. I mean, my gosh. The government's going to issue $2 trillion of new debt. That's got to go someplace, but it's going to be spent by the government, and that's going to circle back. So I think they're doing the very wise thing, holding on, seeing where things are, and then making a decision when they have the right amount of information and they know where things are. And they use the tariffs as their explanation. That's certainly a legitimate concern for holding back. So is the budget process that's underway right now.
Tom, just between friends, nobody's listening. Did you find the meeting on Wednesday interesting in any way, shape, or form?
No, I didn't, except for one thing I will say. It was exactly as I expected, no change, the tariffs being the issue and so forth. But what I was disappointed with, there was only one question from the press about the budget, how that might affect things. And I think it's a bigger deal than that. So that kept it boring, and maybe that was intentional. I don't know. But I'm glad it was boring for the most part, but there's still a lot of questions out there that need to be addressed at some point.
We got to start a campaign to get you in the room with the media next time around. So the budget could be a bigger issue. What is the concern? Because it is one for now that sure maybe a little bit of a higher term premium for the bond markets, but the market hasn't been reacting that much. What are you looking out for as the big, beautiful bill makes its way through Washington, D.C.?
Well, it's kind of a delayed reaction, right? But this bill will add more to the debt, which is going to be, it's $37 trillion now at least. In 10 years, it's going to be well over $50 trillion. It's only going up. It has to be funded. I mean, that's what you're seeing right now. I mean, stable coins, the big talk is that's going to provide a greater demand for government securities. That's what they want. The fact that they want to exempt treasuries from any kind of capital standards, which makes the cost of capital to the largest banks no cost of capital for holding government securities, increases demand. So it's all about increasing demand for government securities, and that will eventually catch up with them when they're expending that much. And when that happens, you have to turn to where? To the Fed. Will it print more money? Will it engage in some kind of quantitative easing to make sure that the interest rates don't go up too high? These are all questions for the future, I realize, but they need to be thought of now, and they're not being I think, taken into account as much as they should myself.
So if they're not taken into account, and point very well taken on the attempt to try to drum up domestic demand for these treasuries, if that's all that's being done, and you don't have a real more serious discussion about the deficit, Thomas, how does it actually end? What is the actual trigger for action to be taken in Washington, D.C. to try to combat what has been a growing issue for some years now?
Well, if they're not going to do it in a systematic fashion, that means it will come up suddenly, and it's going to come up in two ways. As this debt continues to grow, two things are going to happen. The fact is that if foreign buyers don't increase a lot, that means they have to turn to domestic buyers. That means there'll be upward pressure on interest rates. Eventually, there'll be upward pressure. When, it's hard to know, but sooner probably than people think. That means there'll be enormous pressure put on the Federal Reserve to begin to buy this stuff. Otherwise, interest rates go up. And if they don't say no and make sure they're clear on why they're saying no, that means that they'll begin printing that money. Inflation is inevitable. Now, slow. And remember, it's not just price inflation, which everyone pays attention to. It's asset inflation. And that's what really has been a major factor in the last decade and a half. And I think it's something that will, worsen yet the distribution of wealth in the United States. And that creates unrest in many ways. Those are all bad things that come from kicking the can down the road a little too often.
Former Kansas City Fed President Thomas Hoenig, thank you so much for your thoughts, and maybe we will learn more in just 2 weeks. Coming up, Alex Altmann of Barclays, Gerard Cassidy of RBC, Lauren Saidel-Baker of ITR Economics, and Deborah Cunningham of Federated Hermes, as we see markets turn around just a touch, futures a little bit positive ahead of the open. This is Bloomberg Surveillance.
The Fed is in this really policy purgatory where they're unable to move because of the uncertainty ahead.
The key area to focus is on inflation expectations.
We may be underestimating what tariffs and higher oil prices could do to inflation.
The Fed is beginning to worry about their mandate being torn in the opposite direction.
This bad news has been really priced in for a while, so we think the economy can handle it.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. We're waiting 2 weeks for everything to see whether the U.S. will strike Iran's nuclear facilities, to see whether we get a trade deal, to see whether the U.S. will pass the tax bill. Danny Berger here with me waiting for the next 2 weeks. Actually, she's here for the next hour, which is a good and beautiful thing. John and Annmarie are both off today, like so many other people after the holiday yesterday. What I am struck by this morning, Danny, is that we are getting a headline reported from Reuters that Iran is ready to discuss limitation on uranium enrichment, and you're seeing markets respond.
Markets are really looking forward to and really pricing in any sign of diplomacy as soon as we get it. That's when we got the turnaround, a very liquid day yesterday with the U.S. offline, but to Trump saying that it would be the famous 2 weeks of discussion. But it seemed to suggest that diplomacy would be possible. Again, this is just another thing that kind of leans into that narrative. But Terry Haynes of Pangea has been arguing that talks with Iran constantly result in the same thing. They use it as a delay tactic and continue to develop nuclear weapons. Is that going to happen this time around? How realistic is it that Iran would completely give up their nuclear enrichment programs?
Which is the reason why any kind of rebound is tepid. It would be more significant if people really believed that this was the end of discussions. At the same time, this has been a market that has been benumbed by all of the potential worst-case scenarios that keep coming out to the fore and don't come to fruition. And it seems as though people are looking past that. You pointed out earlier, Danny, we're trading in the tightest range in months.
It's a really tight range for equities, for bonds. You can't say the same for oil. It's been bouncing around. In fact, oil has gained 20.5% so far this month. That would make it the biggest monthly gain since 2020. In that same time period, stocks are up just under 1%. Bonds are up 0.5%. There seems to be a disconnect between the assets.
Yeah, and part of the disconnect comes from what we heard from central banks and really around the world, which is a lot of them are looking through this. A lot of them are saying that this is a one-time shock, if anything, is going to weigh on growth more than really boost inflation. And we're seeing rate cuts around the world. We saw that overnight with Norges Bank. We saw that with the Swiss National Bank eyeing negative rates once again. So you wonder whether that becomes a theme as well globally. People looking past the inflation shock, looking more toward the potential hit to growth.
How much does a Fed on pause also allow for that to happen? People looked at the Fed decision saying 2 cuts, it's still really dovish. Neil Dutta, though, pointing out how dovish can it really be? In fact, it was such a drastic split between the hawks and doves. If just one committee member had revised their 2 cuts to none or to 1, you would have had the average be 1 cut priced in. So there's a lot of wiggle room there.
Yeah, meanwhile, we are watching what's going on in the Middle East. Coming up the next hour, Alex Altmann of Barclays with stocks stuck in that tight trading range, as Danny was talking about. Gerard Cassidy of RBC on changes to U.S. bank regulation, and Lauren Saidel-Baker of ITR Economics and why she expects inflation to rebound. We begin this hour with stocks inflected slightly up as President Trump considers strikes on Iran, but we are getting some signs that maybe Iran is willing to take the diplomatic approach. Alex Altmann of Barclays writing this: markets were given the opportunity to have a material negative reaction to this serious geopolitical escalation, yet we're met with a pretty benign risk response. Alex joins us now for more. Alex, wonderful to see you as always.
Nice to see you.
It is important to understand what the market is telling us by its benumbed reaction. What does that tell you in terms of traders' appetite for risk and their willingness to look through a lot of potential shocks?
I think we start with positioning. Let's just do that, because I think you can paint a very bullish scenario about the world. Despite what's going on right now, you can say that there's a lot of interesting developments with regard to 2026 growth, whether it's AI, so on and so forth. You can also paint a very bearish narrative, and I don't think we need to discuss that, but obviously the bearish narrative has moved around aggressively for the past 6 months, where there's been deficits and trade and tariffs and now obviously geopolitics. But positioning for me is a deciding factor, and the fact that, as you said yourself, the market hasn't really done very much in spite of we had bad retail sales and we had arguably a very ambivalent Fed, and we've obviously had what's happened with geopolitics, and yet the S&P is up for June, and that to me is telling us positioning is still not particularly aggressive from an institutional client-based perspective, and that's something that we can still build on over the next few weeks to the top side.
Well, it's not particularly aggressive to the downside or the upside, right? So why are you confident that it's going to flip to the upside rather than the downside in this sort of numb state?
Sure. So I think there's a couple of things. First of all, we've got to think about AI, right? So from an AI perspective, what I was most surprised about is at the beginning of this year, most of the analyst community would thought that 2025 would be the apex year for AI capex. Now it turns out that 2026 is going to be even higher than 2025, and those numbers are still going up. We're talking in excess of $400 billion of capex spend in the AI space. That alone is going to add over 1% of GDP. And of course, the passage of time as we move closer to 2026, analysts are going to start having an eye on the 2026 forecast as opposed to 2025. 2026, we're already talking about numbers on a blended 12-month forward basis. The S&Ps are only trading again all of a sudden on 21 and a half times. By the time we get to 26, we're trading on around about 20 and a half times. So all of a sudden, we're not trading at a significant premium to the long-term average. And this, I think, is important, which people are going to have to keep an eye on. That's also going to anchor the S&P as we get closer to through the year.
But if it's AI that's coming to save the day, if it is these hyperscalers that keep spending, does that not get us back to where we were at the start of the year? That part of this narrative for ebbing American exceptionalism was the concentration of the market and the rich valuations of these players. Obviously, there was some politics in that as well. But if it continues to be AI, do we get back to a market where every day we look at it and say, oh, no, it's just NVIDIA dragging us higher. It's just the Mag 7. Concentration is a problem again.
So that may well be the case. And obviously, we don't know what necessarily the world's going to look like 6 months from now. But I would say that positioning in that AI trade is a lot lighter today than it was in January, number one. Number two is that if you look at the performance of the Mag 7 versus, say, equal-weighted S&P, it's actually underperformed year to date. So there's room for that to become more extended as well. And number three, just think about the number of companies that have started to come out talking about the productivity improvements they're getting from AI. So Google talked about 10% improvement in their engineering capabilities. Microsoft said that they've got between 10 and 20% improvement in productivity from Copilot. Even companies like Volvo talking about improvements in their productivity in terms of manufacturing. These are just some of the anecdotes I can think off the top of my head. This is just the beginning, right? So I think there's a productivity aspect that really could actually propel the S&P up materially over the next few months.
But when you say productivity, I also think of job losses. Microsoft, we learned, is looking at firing folks because they can be replaced by AI. Andy Jassy sending out an email to employees this week saying something sort of similar. Does that also not have a dampening effect on the overall market? If you do see job losses because of AI, whether it's an excuse or not, and then increased demand because it adds to what already feels like a very fragile labor market right now?
I think that is definitely the potential, not left tail, but that is the risk of this AI narrative, is that the very thing that we get excited about ends up being the undoing of the very narrative. And we could already make the case that we're already seeing kind of peak employment within, say, the hyperscalers. A lot of these companies just don't look like they're going to hire anytime soon. And being a software engineer was the most coveted job in the world a few years ago, and it's questionable whether that's still the case now. Again, I just think that trying to predict too far in the future with these big structural trends is difficult. All I know is that if we look back through history, through these big seismic changes in technology, generally it's good for jobs rather than bad.
Do you buy that you could see U.S. stocks continue to outperform even with the sort of structural move away from the dollar and the fact that you are getting easing from central banks in Europe, even as the Fed remains on hold?
So, I mean, there's a couple of things, right? So first of all, we've got to work off the assumption, okay, if U.S. stocks do go up, if we're right about that, and if, for example, we begin to see some kind of bid underneath the bond market, whether it's because of the upcoming QRA or whatever it may be, then if stocks are up and bonds are up, then is it necessarily bad for the dollar? So there's that which we've got to consider first. The second thing is just look at the actual broader market in terms of how beneficial it's going to be for the narrative for investors in general towards this kind of direction. And I don't know, I just think that we're in an environment where it's very easy to be bearish, and it's not that easy to be bullish right now. I think most investors we talk to are not particularly bullish at this particular juncture. And I think that in itself is just not just from a contrarian perspective, just think about the general positivity that I think that actually can be outlined. I think is actually the natural direction for risk right now.
So let's put some numbers on this. Just how overweight are you to the United States, and how much more bullish have you gotten over the past, say, 3 weeks, as you haven't seen those significant moves in response to geopolitical shocks?
Well, if you remember, at the beginning of the year, we were pretty negative on the US. So we were out there sort of touting the end of US exceptionalism. And I feel like that narrative played out pretty well. Now I think we've got to the point where actually there's a lot of investors have begun to move money out of the US. But at the end of the day, if we go back to that AI story, there is only one region that you can invest in to get AI exposure. And so do I think it's the end of US exceptionalism? I do not think that's the case. I think even if you were to make a case that the end of US exceptionalism to diversify internationally, corporate exceptionalism here is still very much here to stay. And I think that's what global investors have kind of realized, that if they want to be involved in the AI trade, they've still got to be putting money to work in the US.
Well, there's also an element where 40% of companies are getting their exposure from abroad in the US too. So even if you just want international exposure, are there really other options besides US large cap stocks? Is this kind of also the trade to say you want international exposure, you can still stay in the US?
There is definitely a degree of that, yes. I mean, at the end of the day, when people try to make these comparisons between, say, the S&P and like the GDP and like market cap being out of whack, they forget that the S&P is a global index. I don't think that really sort of detracts from the fact that some investors will want to diversify to non-US equities. That is what we've seen so far in 2025. Europe has been an interesting story. We've been very bullish, for example, on parts of LATAM. There's parts of parts of Asia that also are pretty interesting here. But the fact of the matter is that if you are a large asset manager with a large pool of capital, the US is still going to be your primary choice just because it's the most deep and liquid market and the best capital market in the world still.
Alex Altman, thank you so much for being with us. Thanks. Always great to get your thoughts on this. Alex Altman of Barclays joining us here in our New York studio right now. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The White House says President Trump will make a decision on whether to strike Iran within the next 2 weeks. White House Press Secretary Caroline Levitt says the president's goal of preventing Iran from obtaining nuclear weapons remains intact. She added, though, that if there's a chance for diplomacy, the president is always going to grab it. Meanwhile, Canada is opening the door to increasing tariffs on U.S. steel and aluminum next month if their trade talks with the White House stall. The U.S. has placed 50% tariffs on foreign steel and aluminum, while Canada has 25% counter tariffs in place on the U.S. And Hurricane Eric weakened to a tropical storm after slamming into Mexico's South Pacific coast as a Category 3 storm yesterday morning. The storm made landfall near popular tourist areas, including Puerto Escondido and Acapulco. At least one person was killed in the storm, which caused landslides, blocked highways, and downed power lines. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the morning calls, plus Gerard Cassidy of RBC on changes to U.S. bank regulation. That's coming up next. This is Bloomberg Surveillance. Futures turning around as you get some positive reporting about a possible diplomatic solution. Reuters citing an unidentified senior Iranian official as they talk about a willingness of Iranians to potentially limit the uranium enrichment. We will bring you more on the story as we get it. S&P futures up about 0.1%, yields higher, 4 basis points higher for the 10-year, 4.4%, and an ongoing decline in Brent, down more than 3% on the heels of that news. Time now for the morning calls. First up, Wedbush lifting its price target on IBM to a street high of $325. Analyst Dan Ives saying IBM is under-owned and in the early stages of an AI renaissance. Next up, Jack in the Box downgraded to hold at Stifel, saying U.S. immigration policies will weigh on already deteriorating sales. Those shares lower by about 1% in pre-market trading. And finally, Mondelez upgraded to overweight at Wells Fargo, saying its bull case for the snack food giant is becoming more tangible. Those shares up about 0.5%. Turning now to financials, which have been one of the better performers that we have seen all year. U.S. bank regulators planning to lower a key capital requirement for the biggest lenders in an effort to ease constraints on trading in the treasuries market. Joining us now, very happy to say, Gerard Cassidy of RBC. Gerard, thanks for being with us. This story moved markets. It sent a bid into the long end of the treasury curve, and it raised a question. If the regulations were lifted, would banks want to buy long-duration treasuries as part of their trading operations?
Thank you for having me on the program, Lisa. The short answer is no. I think you touched on it in your opening comments. The primary driver for relaxing the standards of the supplementary leverage ratio known as SLR is to ease up the stress that happens on the balance sheets of the primary dealers during volatile times. And so by lowering this ratio, it's going to give them expanded capacity or greater liquidity to be able to trade these securities during that volatility. That's the primary purpose, rather than the banks going out and buying 30-year treasuries for their portfolio. Not to say that may not happen, but that's not the primary reason for changing this legislation or changing this regulation.
Gerard, how much is this important to you, though, for another reason? The idea that if this does happen, it indicates the quick pace of deregulating the banking sector really is underway and gives fuel to the narrative that really has driven a lot of the performance in financials year to date.
Very well said, Lisa, because you're absolutely right. One of the real tailwinds and positive trends for the banking sector and why we remain bullish on the banks is what you talked about, which is deregulation. When you think about July or summer of 2023, when the initial Basel III endgame proposal came out, the expectation back then was that the capital requirements for all the big banks were going to go up meaningfully, very meaningfully. In fact, JP Morgan and Goldman at the time, if I recall, were talking about a 20 to 30% increase in capital requirements. That, of course, has been thrown out. And now the new proposal that we expect will be greatly watered down, and the capital levels will probably remain unchanged. But relative to what we had in summer of 23, it's meaningfully different, which means the banks now have excess capital. And I think what you're going to see is much stronger buyback activity amongst the biggest banks over the next 12 to 18 months.
Gerard, can you put some numbers to it? Just how much stronger could buyback activity become as this unfolds?
It's a good question, Danny, because when you think about it, the banks are very profitable today. When you look at the FDIC data for the first quarter and you annualize the net income, we're at record levels. And the banks are generating such excess levels of capital every quarter. And because we're obviously a mature economy and the industry is a mature industry, they cannot put it all to work to grow their organically because there's just not enough demand. So they need to do something with this excess capital. Acquisitions is certainly something they'll choose to do. And that's another area, by the way, which is likely to pick up its speed in the second half of this year because of this deregulation, but then buy back stock. And so when you look at the peak levels of shares outstanding of the top 20 banks post-financial crisis, what you see is that many of the biggest banks have been actively buying back their stock. For example, Goldman Sachs, their shares peaked in the first quarter of 2010. Their share count is down 45%. Regions Financial, one of our big regional banks, their share count is down by over 35%. So I think what you're going to see is banks buying back every year, anywhere from 2 to 5, maybe even, 7% of shares outstanding if they have the excess capital and if growth, again, is modest.
If growth is modest, Gerard, part of the concern about some of this SLR reform and in general, the higher issuance of treasuries that we're seeing is that banks are going to be asked, I know you question this as just how much they will, but are going to be asked to absorb more treasuries. That brings it up the criticism that the banks become more of an intermediary between the government and its depositors versus its depositors and private corporations in the U.S. and corporate America. Is that a real change that could happen as there's more supply, that the money flowing to fund and loan to corporations in the U.S. is lessened just because of the amount of government debt that needs to be absorbed?
It's a really interesting question because when you think about it on the surface, you would have to certainly be concerned about it. But when you listen to Treasury Secretary Bessent, he has obviously been very vocal about getting the banking industry more involved in the U.S. economy. This administration knows that to grow out of the deficits we have, we need to engage the banking industry more so in lending into the U.S. economy. So if they were to pressure the industry to buy more government securities, as you point out, that would certainly have an impact on growing the U.S. economy. So again, I'm hesitant to, and I don't believe that's going to be the pressure point. The real, the force is let's get the banks involved in the economy, grow the economy so that it'll lessen possibly the deficit and the problems we have with government debt in this country.
Gerard, let's put the Treasury story aside for 1 second. One of the other tailwinds for financials so far this year has been this belief that we will get some sort of M&A resurgence, and we really haven't seen it. There is a feeling that maybe the second half will be more robust, and yet we have gotten some predictions from the Bank of America as well as from JP Morgan executives who've come out and say they do expect mergers, acquisitions, deals in general to be less active than they previously expected. How much do you think this is a hit to the narrative that really has driven some of the upside in these shares?
We certainly are expecting more bank M&A. And when you look at overall M&A, it's not just the banking sector, but when you talk about all the sectors, it's been more muted this year. Obviously, April was a really quiet month, so M&A activity in general has slowed down. But let's come back to just the banks. And when you look at the banking sector, Lisa, as you and I have chatted over the years, we used to have 18,000 banks and thrifts in this country in the 1980s. We're down to about 4,600. So the consolidation of the industry has been ongoing for decades. And the reason we expect it to pick up is that what we're going to see is that with the regulators being supportive of M&A, in the prior administration, they weren't as supportive of it. It's going to give the potential buyers more confidence that they can announce a deal and have it closed within, let's say, 6 months versus 12 to 18 months, which was the case in the prior administration. Plus, I think what we're going to see for a renewal, Lisa, is activist investing. I think what you're going to find is for banks that haven't delivered for their shareholders, that activists could get more involved into their stocks. We haven't seen that in some time. Generally, it has not been successful. But what with this regulatory outlook being less, harder on the industry, I think they may be more supportive of activists to encourage this consolidation for the banks that are not delivering for their shareholders.
Gerard, Cassidy of RBC, thank you so much for spending time with us. Right now, we're seeing in markets turn upward. Futures up more than 0.1% on the heels of reporting from Reuters. Reuters reporting that Iran is ready to discuss limitations on uranium enrichment. They do say that zero enrichment will undoubtedly be rejected, especially now under Israel's strike. This is according to an official speaking to Reuters. And Danny, markets are responding.
Should they be responding? Okay, a slight response, fine. But just that last note that you said, that zero enrichment will undoubtedly be rejected. Trump has said he wants total surrender. We don't know what total surrender means, but it could be zero enrichment. So Iran has already said that that's not going to be an okay thing to be brought to the negotiating table. If anything, though, it does just put the increase of concentration of what's happening in Geneva. You have European powers meeting with their Iranian counterpoints. Is this the start to negotiations? Is this maybe what's behind Trump saying, let's have 2 weeks, maybe diplomacy can be achieved?
And this is the reason why some of the heat in the oil market being taken out after a more than 20% rise so far this month alone, as people try to game out what some sort of disruption to Iranian production could look like. We will continue the conversation coming up. Lauren Saidel-Baker of ITR Economics and Deborah Cunningham of Federated Hermes on inflation expectations and central bank responses to them. This is Bloomberg Surveillance. Welcome back to Bloomberg Surveillance. We are seeing a bit of a lift, a reversal from earlier this morning in futures, as there is reporting from Reuters that Iran is open to curtailing some of the uranium enrichment. Still limited gains, but still a market reversal from earlier, up 0.2% for both the S&P and NASDAQ futures. Russell 2000 really the outperformer this week for the first time in a long time, which is probably why they're outperforming, up about 1% right now, 21.49. When you trickle this through to the bond space, yields higher across the board, particularly at the long end, now 5 basis points higher, 4.94% on that 30-year. 10-year yields up also about 5 basis points, 4.44% on the 10-year, and 2-year yields up a more muted 2 basis points, 3.96%. When you look at the crude market, that has been the most direct response that we have gotten from some of the back and forth about Iran and Israel and the U.S. getting involved or not. And you could see that reducing the temperature reduces the price, down 3% for Brent crude, $76.45. 1 hour away from the cash open. Here are your morning movers with Yahira on it. Yahira.
Hi, Lisa. We got a flurry of movers this morning because of earnings. We start with Accenture. Those shares are down 5% after it posted a sharp drop in new bookings. They fell 7% in the quarter, and Bloomberg Intelligence says that it's a sign that discretionary IT spending by companies remains soft. And while Accenture did slightly raise its full-year outlook, BI says it was driven more by cost-cutting than a true demand spike in tech. Next up, we have shares of CarMax. Those are soaring up 9.8%. This is the largest used car retailer in the U.S., and its results were solid. It posted higher profit and higher sales in the first quarter. Not a surprise at a time when shoppers are, of course, trying to avoid tariffs. And, of course, one way of doing that is buying a used car. And we end with the company behind Olive Garden and Longhorn Steakhouse. That is Darden Restaurants. Shares are up 3.3% after sales rose 11% year on year for them in the past quarter. And that was essentially in line with expectations. But it tells us that consumers are still eating out amid all this macro uncertainty. Also getting investors excited is a dividend boost and news that its board has approved a $1 billion share buyback program. I'll pass you the breadsticks, Lisa.
Thank you so much, Yahira. Talking about breadsticks, actually, retail sales showed that more people were eating out, and that was the greatest proportion of retail sales of consumer expenditures of the retail sales that we've seen on record. We got that data earlier this week.
It's not what you'd expect if it's a nervous consumer, if they want to save budgets. It's usually one of the first things that gets a pullback, so good sign.
Again, it's sort of, you can paint a good story, you can paint a bad story. Turning to how the Fed deals with all of this, Fed Chair Jay Powell saying tariff impacts are coming as policymakers wait for clarity. Bloomberg's Michael McKee joins us now. Mike, how much reaction was there to Wednesday? Was it just watching paint dry? And is that really the success?
I suppose you could call it that, Lisa. Nobody knows what's going on. Jay Powell made that clear. And numbers just out now show the Fed's dilemma. The Philadelphia Fed Business Outlook Index falls to -4 from stays at -4. The forecast was for an increase to -1.5. But the interesting thing is that the new orders index drops a lot, employment drops a lot, but so does prices paid. So are we getting inflation or not? That was the centerpiece of the chairman's testimony last week. We're all thinking this is a new week. Earlier this week, Jay Powell goes up to Capitol Hill on Tuesday. Can he top what he did? For excitement, he could, but can he find anything to say? He said the economy was still solid. The Fed left us with 2 dots for 2025. Unemployment and inflation will rise, Fed officials said. But Powell made it clear there is, quote, no great conviction on forecasts. In other words, don't take us very seriously here because we don't know any more than Wall Street does about what's going to happen. We'll get more people besides Jay Powell next week who will be talking a plethora of Fed speak. You look at what we've got. Mary Daly speaks on Sunday, then Waller, Bowman, Goolsbee, Kugler, Williams on Monday. Powell up on Capitol Hill to testify to the House Financial Services Committee. First day of his Humphrey Hawkins testimony. He comes back on Wednesday, Thursday, and Friday. Also more Fed officials, although some of those are just welcoming remarks. But we'll get enough Fed speak next week to find out if anybody is going to go beyond what Powell says and say, we are actually thinking this is going to happen, and we have some conviction on it.
The Fed speak making up for lost time. Michael McKee, stay close. We'll get back to you in just a second. Lauren Saidel-Baker of ITR Economics writing this. Inflation will likely rebound in the second half of 2025, likely limiting the FOMC's ability to cut rates. Lauren joins us now. Lauren, how much did you see a Fed that really is waiting for a reason to cut and is likely to remain on the sidelines more than people think?
Yes, we're back to quote unquote data dependent, which it's a very interesting place for the Fed to be. They used words talking about the labor market as solid or healthy. At one point, Chair Powell said close to full employment, at or near full employment. So when you couple that with these rising inflationary pressures, both due to things like tariffs, maybe the war in the Middle East is simmering down a little bit, so we won't get that pull on energy prices. But we have very fundamental reasons that we are looking through to the second half of this year with higher price levels. That's fundamental, kind of boring, nerdy things like fiscal and monetary policy. We still see upward pressure on wage costs. So at the end of the day, with inflation pressures building, with the labor market still in balance, this is not the typical environment that we are talking about rate cuts.
So if inflation is picking up, and it does in the back half of the year, Lauren, just how weak does the labor market need to look for the dual mandate to shift back to it and allow the Fed to cut?
That really is the question. I don't see many fundamentals on our radar that would say weakening in the labor market, at least a significant degree. From a numbers perspective, we're very much limited in terms of our labor market, just the demographic trends, with Gen Z being a much smaller generation, certainly not sizable enough to replace all of those retiring baby boomers. Over the near to middle term, we do have just those numbers working against us in terms of how many people can we put into the labor market. So I would say demographics are the big driver here for that long-term swing in the labor market. And even today, where we have had material loosening from the tightest point of this labor market, it still is a rough balance, one unemployed worker per each available job opening. Historically, we typically have multiple job seekers for each job opening. So when we talk about balance, keep in mind, by a broad historic scale, this is still tight. And for most businesses, this still feels very tight and very hard to hire.
Just taking a big step back, Lauren, most people would look at that and have this worry. Are we getting back to the 70s where you could see real wage price spiral of inflation because of the dynamics you're talking about? We haven't quite seen it to that extent. Maybe it has to do with globalization, the fact that there is cheap labor abroad and cheaper goods coming in. If we are changing to a world that's more multipolar, that's more insular, do we need to start worrying about that 70s dynamic over again?
There were some very different drivers in the 70s that I don't think will be repeated this time around. But yes, anytime we look at that globalization versus nationalizing, I think of it kind of as a pendulum, right? The pendulum swings one way, it swings back again the other. We were certainly swinging toward nationalism. So with tariffs in effect, I mean, that will cause some upside pressure on the goods side of the economy, especially with what we tend to import. Just where we have focused our resources, it's not on being that lowest cost producer. So this will bring new pressures. I think there'll be slightly different pressures than our country has seen in the past. But coming back to those more elevated inflation levels, I don't think the 70s and 80s inflation levels are back on the table, but I'm looking at something more like the 90s, the early 2000s. That was significantly higher than the prior decade, pre-COVID. We saw very, very low inflation. So I think for both businesses and consumers, it's going to take a mindset change to adapt back to a very different environment.
Lauren Saidel-Baker of ITR Economics, thank you so much. One thing that we have seen is a tight trading year, tight trading range. The U.S. 10-year trading really in its narrow span, despite a busy week, including comments from Fed Chair Jay Powell. Bloomberg's Michael McKee is back with us. And Mike, I want to kind of surprise you and throw something at you, because right now we're getting some headlines from Chris Waller of the Federal Reserve, Fed governor, speaking on in another news outlet, saying that the Fed doesn't need to be on hold much longer and could cut rates as early as the July meeting. How out of the mainstream is he?
That would put him pretty much the farthest out on the hawk-dove curve as far as being dovish. You get results like the Philadelphia Fed this morning, where prices paid went down. If we don't see a big rise in inflation from tariffs over the next month or so, that could be a possibility. But I think it is definitely an outlier, Lisa, because at this point, the Fed doesn't have the data. So they would have to have some reason to move that hasn't shown up yet. The 10-year you mentioned is trading in a fairly tight range. We saw some volatility volatility on Wednesday when the Fed first put out its dot plot. We saw the 10-year yield go down. And then on Wednesday afternoon, when Jay Powell spoke, it went back up again. And now today we're trading about where we were when the week began, a round trip. And it raises the question of who is right. The bond market seems to be siding with the president at this point and suggesting that the tariffs are not going to cause a lot of damage or a lot of inflation. And they're not going to send the country into recession because of the bond, the budget bill up on Capitol Hill. A lot of people think that that's going to be recessionary. It's going to create a big deficit problem, and it's also going to join the tariffs in slowing the economy. But at this point, the bond market doesn't think so, and people are wondering, where are the vigilantes at this point?
Michael McKee, thank you so much. On the heels of those headlines from Fed Governor Chris Waller, you are seeing the two-year yield now lower on the day, 3.94%. It raised a question. If the Fed were to cut rates as soon as next month, how much would that increase yields on the long end of the yield curve, on 10-year, on 30-year yields, considering that people think this could potentially add to inflation over the longer term? Joining us now to answer that question is Deborah Cunningham of Federated Hermes. Deborah, what's your sense of the consequences for 10-year yields, for 30-year yields, if the Fed were to start cutting rates as soon as next month?
Well, it's still the expectations of tariffs hitting. Even if we go through the month of June, we go into the month of July with inflation actually lower, the brunt of the tariffs still are at least 60 days away. They keep being pushed out. You know, we said back in April they were 90 days away. Now we're 2/3 of the way through that hiatus with only minor differences. So I think the 10-year and the 30-year remain cautious. I believe that the tight range that they have been trading in will continue. You know, I know the 20-year auction did not go well with last week, I think it was, but it's kind of an outlier. The 20-year doesn't have the same support necessarily on any given day as the 10-year and the 30-year. So I think both of them will continue to be in a range that's probably not more than 10 or 15 basis points from where it is today.
Deborah, you could drive yourself crazy trying to look out for something that shakes the market and gets it out of a range, from a one big beautiful bill to trade policy to geopolitical shocks and war. What is the bar to actually move this bond market at this moment?
Wow, that's pretty tough. You know, Michael was saying that it was, a snoozer from the Fed meeting on Wednesday. But I think still, and I'll go back 2 meetings ago, the press conference where Chair Powell talked about, in an answer to a lot of different questions.
Deborah Cunningham of Federated Hermes, thank you so much. We seem to have lost the connection. Everyone is going on vacation early, even people who are connecting the wires. Right now, what you can see in markets is a sell-off in the long end of the yield curve, something that I know that you picked up on as well, Danny, in response to this idea that possibly if Fed Chair Chris Waller ends up being Fed Chair Chris Waller come early next year, it could be a pretty dovish Federal Reserve.
I was going to say, the fact you're seeing a market reaction, I don't think is anyone saying, oh, maybe we'll actually get cuts in July. I think that's so far out of the consensus. You're spot on. What we are maybe seeing is Waller, the idea, maybe is positioning himself to be Trump's next Fed chair. So just how much more easy does policy get next year if this is the kind of language coming out right now?
And we're seeing that getting priced into markets with people looking at back-end cuts, right? The idea that you might not get any cuts from the Fed this year, but they might be much more aggressive early next year with a change of the guard in terms of who is the Fed chair. Just a reminder, what we actually got, Chris Waller, Fed governor, coming on CNBC saying that he doesn't think that the Fed needs to wait much longer to cut rates, and saying that they could cut rates as soon as the meeting next month, excuse me. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Anand. Yahira.
Hi, Lisa. The White House has scored a legal victory over its deployment of National Guard troops in Los Angeles. A 3-judge panel ruled the Trump administration can continue using the Guard to respond to anti-deportation protests. The decision, of course, is likely to be challenged by California. Meanwhile, American and United Airlines suspended daily flights from the U.S. to Doha due to the heightened tensions in the Middle East. Other airlines, including Delta, Air France, and Air Canada, have also suspended or even canceled routes to cities in the Gulf region due to airspace disruptions. And the NBA Finals are set for a decisive Game 7 after the Indiana Pacers held off elimination against the Oklahoma City Thunder. After a slow start, the Pacers pulled away in the second and third quarters, and they never looked back. They won by 17 points. It'll be the first Finals Game 7 since 2016, with tip-off set for Sunday night in Oklahoma City. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahaira. And thank you for this morning. Have a wonderful weekend. It's going to be a hot one. Up next, setting you up for the week ahead. Plus, Bloomberg's Craig Trudell counting down to Tesla's robotaxi launch and just how long it'll take before we're being driven around by robots. This is Bloomberg Surveillance. Good morning. Welcome back to Bloomberg Surveillance. We are building on gains that actually started just a bit ago when Reuters reported that Iran was open to curtailing some of their refinement, seeing that near session highs now. Futures on the S&P up about 0.33%. Similar move for the NASDAQ. In the bond space, being affected by what Fed Governor Chris Waller said just moments ago when he was talking about the likelihood that the Fed could even cut next month, as soon as next month, saying that this was a Federal Reserve that should look through any potential inflationary impacts from the tariffs. Right now, you're seeing that in the front end, just 3.95%, still lower than before his comments. But on the long end, the same sell-off as people look to inflation. Counting down to the opening bell, here is the trading diary into next week. 11 a.m. Eastern, President Trump attending a national security meeting. Sunday, Tesla's planned robotaxi launch in Texas. Monday, we get June PMIs. Tuesday, we get consumer confidence. The NATO summit kicking off, and Fed Chair Jay Powell testifying before the House Financial Services Committee. Turning back to Tesla, its long-anticipated robotaxi is set to launch on Sunday in Austin. Joining us now is Bloomberg's Craig Trudell. And Craig, we were excited to hear that this could be getting closer to fruition because we both are thinking about the possibility of being able to ship people around without thinking about it. How much is this going to be a watershed moment for a really beaten-up company in Tesla?
I mean, it's a long time coming, right? Where, I remember hearing Elon Musk talk about how we were going to have 1 million Tesla robo-taxis on the road in the year 2020, right? And he said that in, I believe it was April of 2019. So this is something that he has long promised and long, struggled to deliver. It is a watershed moment if and when he's able to put cars on the road that won't actually have people behind the wheel. But I think, in terms of what we expect on Sunday, it is going to be, a far cry from even, what was promised back in 2019 when, Musk was talking about, a lot of cars being on the road capable of driving themselves. In this case, they're really keeping this to a small group of potential customers. They're sending out invitations to, I guess you could call them influencers, big Tesla fans and Musk fans that are likely to be, quite forgiving to the extent that there are any issues, any early hiccups. And, they're also keeping this to a contained area in one city with a handful of vehicles. So this is still, very early goings for them, and it's going to be quite some time before we get a sense as to whether or not this is going to be at all impactful to this company that, as you mentioned, is having a lot of challenges.
Fresh in probably a lot of people's minds, too, Craig, is October of last year at that We Robot event that Musk had. And there was a lot of disappointment. He rolled out a prototype for the Cybercab. There was also hope at that time that he had to have a cheaper vehicle. It wasn't there. Given how that event unfolded, What is the bar for this weekend? Just how much is the analyst community actually expecting, given some of the squishiness of prior timelines for Tesla?
Yeah, I mean, this is a company that is so divisive, right? Where you do have a lot of analysts who, despite all of the sort of unanswered questions and things that were left unaddressed at that We Robot event, some just kind of took the excitement of fresh metal, a prototype, got excited about it. And there was that event was successful in the sense that it drove this rally in the shares in the lead up to it. And we're seeing a repeat of that in terms of this robotaxi launch, right? Where despite the fact that Tesla's sales are not showing indications of market recovery from what was a really dismal first quarter, we're seeing the shares tick up just around this idea of Musk kind of driving a narrative again for the stock. And so even in the event that we don't see a real sort of needle-moving change in Tesla's financial situation as a result of this launch, it at least is changing the conversation. We're talking less about what he's up to in Washington and about the demand issues, and more about these bright, shiny objects for the future.
Craig Trudell of Bloomberg, thank you so much and have a wonderful weekend. Just to recap, if you are just joining, there are a couple of developments this morning that have shifted the tone in markets, albeit it was a pretty calm day to begin with. But right now we're looking at gains on futures heading into the open. We are about 35 minutes away, and we can see those gains near session highs as we look to Iran, ready to discuss limitations on uranium enrichment. This according to an official familiar with the matter in Iran who told Reuters this is definitely affecting the mood, where you are seeing a lift across the board. The Russell 2000 getting the 1-2 punch from both this headline and from Fed Governor Chris Waller coming out earlier this morning and saying they could cut rates as soon as July, at a time when some people are wondering what the scenario analysis is going to be for a Fed unclear on how to handle the tariffs.
And he said we could cut in July, and then I think the direct quote was just kind of see what happens with inflation. I think a lot of the other FOMC members would not be happy with this idea, to just kind of see what happens with inflation. And that's some of the pushback, because you could argue that during COVID, they just kind of saw what happened with inflation, and then they were criticized for waiting too late. So there's some recency bias in there. Waller really standing out is very different from the rest of the committee. It brings up the question, how much of that is his audition for 2026?
Or anyone's audition for 2026 who will get that Fed chair job, given the fact that President Trump has been very vocal about his disapproval of Fed Chair Powell, saying he will not be in that seat come early next year. Will this be a Fed more inclined to cut rates come January?
The irony, of course, of that is that you see this market reaction being the reaction to that idea, which is the opposite of what the White House wants. They want yields to come in. They want demand for especially longer dated treasuries. But even just the suggestion of a cut has had the exact opposite effect.
Well, coming up on Monday, we'll carry the conversation forward. Lori Calvasina of RBC Capital Markets, former U.S. Secretary of Defense Mark Esper, Marissa Adams of HSBC, and Vinu Krishna of Barclays. Danny Berger, thank you so much for being with us. A pleasure having you here as always.